for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
After this infrastructure bill has got to come this summer an income tax plan. And all of that's going to weigh very heavy on this market.
When you have stimuli of this size around the world, there's definitely taxes coming down the line, whether it's corporate taxes or capital gains increases.
We might be working ourselves into an uncompetitive situation.
That problem probably wouldn't be good for the U.S. economy.
The president's calculation is that there's a need to modernize our infrastructure. His view is that that should be on the backs, that can be on the backs of the wealthiest Americans who can afford it.
Some of the reaction to the potential Biden tax plan coming out in the next several weeks. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Friday morning. Closing out the week potentially with a week of losses on the S&P 500, set to bite into that up by 0.2%. Positive 9 points following the biggest one-day loss going back to March 18th. In the bond market, yields are higher by a basis point, 154.72. 3 straight weeks of gains, though, for treasuries. Yields lower, sub 155, Tom. That's been the story of the last month or so.
Yeah, it is. I mean, it's really interesting going into the weekend, John. And what I would note is everybody's still betting on a higher inflation stream. You see it in the money flows into some of the inflation protection products. And John, you really wonder, can that happen? Can you come to fruition with a truly higher inflation?
On top of that, Tom, the tension between a conversation we're having in America and a conversation we are not having abroad right now. Talked a lot about India and Japan yesterday. Let's talk about Russia right now. The President, Vladimir Putin, set to order May holidays to be extended to control the COVID spread. The reality in America, unfortunately, is not the reality in many other nations.
We had a chilling conversation with someone from Johns Hopkins yesterday over the shock of lack of oxygen in India. That's certainly the difficult tone into the weekend. Benjamin Bain is at Bloomberg News. He's also familiar with Johns Hopkins with his graduate work there as well. We're thrilled that Ben Bain could join us this morning. Ben, long ago and far away, Reagan got together with the Democrats and they modeled the tax angst of America down to a compromise statistic. Is that assumed in your Washington?
It's a different time, is what I would say. I mean, we're in a really polarized moment here in Washington. And I think it's worth taking a step back and realizing that this plan that that our colleagues here broke news about yesterday probably could never happen if it wasn't for those 2 Georgia seats the Democrats picked up in January. So you're in a situation now where Biden's really going big. And, you know, this is the first salvo. This is where this administration wants to go. Republicans are already coming out, throwing a lot of cold water on this. You heard some business leaders, we just heard, you know, they have their own opinions as well.
What's the temperature of the bucket Senator Schumer has? I mean, has he got cold water in the bucket or has he got hot water in the bucket in support of his president?
Hasn't come out yet definitively either way. Obviously, you know, it's going to be real important where he comes down on it. I mean, this is early days, let's say, right?
Early hours.
This is going to be early hours, yeah. And, you know, and I think the Biden administration is going to be going on a roadshow basically here for the next several weeks and months. I mean, they're going to try to sell this, and what we're going to get eventually probably isn't what we started with yesterday.
Lisa, help me and John here and Ben. You're expert at this as the New York woman. What is Senator Schumer going to do about this?
Well, I think it has to do also with the SALT cap deduction, basically what could end up bringing the New York State tax rate up to 52%. Well, I mean, no, for up to 52% at the uppermost brackets behind only California. This is a key issue. There is a question, though, before we even get there, is how realistic is this plan? There can't be any defections. And Ben, you know, Tom was talking about Senator Schumer. I'm thinking about Joe Manchin. How much are we actually looking at a plan that could get passed with Democratic support?
I mean, that's the real question, as you're saying. I mean, the Democrats, the Biden administration really needs no one to leave. Literally, it's 50-50 with the vice president breaking the tie. So, you know, I think it's going to be a really tight line they have to walk. And I think you're going to have to eventually, probably, we're going to see some compromises here, like everything in Washington. And yeah, Joe Manchin, again, we're talking about, Joe Manchin is in every single conversation here in Washington. Ultimately, he is that swing vote, and they're going to have to sell it to him.
I can't keep track, Ben. We have the $2.3 trillion stimulus that President Biden proposed. I'm not sure where that is. There's some bipartisan, sort of skinny stimulus, city infrastructure spending that's out there. But then there's also going to be the American Families Act that's coming out next week, which proposes a whole new round of measures. I mean, is this basically just Joe Biden throwing everything at the wall and hoping to see what sticks?
Well, we're going to hear all about that next week. He's going to give his, first joint speech to Congress, so it's kind of must-see TV on the 28th. We're going to hear about all of his plans, but this tax debate is really tied to how he's going to pay for all of this. So you mentioned the infrastructure plan. Republicans came out yesterday. He's calling for $2 trillion plus. The administration is. They're calling for something more in the neighborhood of $500–600 billion. Big difference there. This additional spending that now we're talking about, that we're going to hear about next week, is more focused on child care, basically the American family. So yeah, we're seeing all of the priorities rolled out, and tax on the other side of this. These plans are how they want to pay for this.
Well, this is important, Ben. William Gale, who is the noted expert at Brookings Institution, did the 2017 tax cut, did it pay for itself? We're going to have the same article about a capital gains tax increase. Is there any evidence in Ben Bain's world that if you raise the capital gains tax, you actually bring in more money?
So there was a study that our colleagues who broke the story yesterday reported on that did talk about the way this would increase revenue for the government over a certain period of time. Obviously, Republicans are pushing back pretty hard here, as are some of the business leaders, and they're saying, look, this is going to hurt investment. This is ultimately going to slow down the economy. These are the same arguments that we always have in Washington when it comes to taxation. We're going to have them in a very pointed way, particularly because we're now talking about a capital gains tax. And ultimately, this is a massive change. If you think about it, for the longest time, income has always been taxed at a higher level than investments. And we're really talking about a major change to the tax code that would change that, potentially flip that around, or at least put that on par.
Ben, we've got to leave it there, but a really thoughtful final response there. Ben Bain of Bloomberg. And that is the issue, isn't it, Tom? An issue of supporting labor over supporting capital, and making a huge change down in Washington, D.C. on very skinny, slim margins in Congress.
Well, it is, John. I mean, the margins there, as he mentions, the two senators from Georgia, and I'll let you do your calculus. Lisa will have a different calculus as well. My calculus is look at history. The capital gains tax model that we've reported on, that Laura's reported on, is back 100 years.
Yep.
I mean, literally back 100 years. Somehow, I don't think this Washington is diving back 100 years.
We'll carry on talking about the consequences, but Lisa, the effort is fairly intuitive and pretty predictable. A source of widening inequality in the last 12 months has been asset inflation. Assets that benefited tremendously from monetary policy and assets that were only held by the upper end of the K. The bottom leg of the K, how do you narrow that? This might be seen as an effective way, at least on the table, as a proposal.
And I think that your emphasis here, and Ben's emphasis, is really important. The idea that as it has been, as taxes have been structured, just keeping your money in the market is perhaps better than spending it on people and things, and this reverses that. What kind of pressure does that put in asset prices, and how much does that boost the economy?
The emphasis of this market has shifted away from pure deficit spending to redistribution. That is a very different conversation. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, Jonathan Ferro. This is Bloomberg Surveillance, live on Bloomberg TV, with equity futures up 0.2%. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy, and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Big tech, such as Alibaba and Tencent, are no doubt national champions. But now China is stepping up oversight. Just how far will the Chinese government go on regulation? We'll explore on a Bloomberg special, Red Lines, China and Big Tech.
From New York City for our audience worldwide, live on Bloomberg Television alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this morning. Equity futures positive by about 0.2% following the biggest one-day loss, going all the way back to the middle of March off the back of a tax proposal, potentially, and some breaking news from the team down in D.C. here at Bloomberg. Equity futures snapping back on the Nasdaq, up 0.2%, on the Russell by about 0.75%. What a 12 months it's been. I talked about the Fed forecast, the projections a little bit earlier on this morning. Last year in June, looking out to the end of 21, the Federal Reserve was looking for unemployment of in and around 6.5%, median projection. The latest projections, they're looking for 4.5% at the end of this year. That's a massive change. Switch out the board and get to the bond market. I'll talk about the relevance of this a million times when you say, look at the data relative to the market. So 12 months ago, when that was the projection, where were yields? 60, 70, 80 basis points. Right now, 154.54. We've had the reset, the huge amount of upside surprises over the last 12 months, the reality that the policy out of DC has been effective, that has put a floor in this economy. So where do we go now, Tom? Yields higher by about a basis point. After 3 straight weeks of gains, yields have been heading lower, even as we start to see better data.
And the key thing there, John, is your phrase 3 weeks. What's so important here, John, is 3 weeks ago, we were modeling a 170 whatever out to 2%, and that's vaporized in 20 days.
The broader point, though, Tom, is that we've been anticipating this for months, and the market has been climbing. Yields have been climbing going into the realized data. So where do we go from here? SocGen thinks this reset over the last 3 weeks is helpful just to set the stage for yields maybe to inflect higher again as we start to process and digest more of that data. So yields higher maybe. Euro dollar, you know the SocGen call, a move towards 125. So finish on this. Euro dollar right now, 120.51. We advanced by about 1/3%. We're starting to anticipate better data in Europe. Not quite the same way as we did in the United States, Tom, but we're getting there slowly.
Yeah, we're getting there slowly, and we'll see how the trend goes here through earnings season. Of course, a lot of other good economic data. I would say on this Friday, labor data constructive this morning. Right now, Sarah House with us with Wells Fargo. Their senior economist. We're thrilled that she could join this morning. Her work at Tulane in the London School of Economics. Sarah, I really want to go to one part of your note, which takes me back to John Taylor of Stanford, and that is anchored, unanchored. How close are we to unanchored inflation?
Well, I think we might be closer than the Fed really thinks right now. And I think importantly, in terms of how much lead time that the Fed has regarding whether inflation expectations are actually getting away from them, it's short. It's very, very short. They don't have, inflation expectations for all the focus the Fed gives on them isn't a very reliable indicator in the short term of how quickly inflation is moving. It's very much informed by the current inflation environment, which means as we continue to see inflation heat up over this year, expectations could get away from the Fed rather quickly.
And then we get language from a central bank, I guess tapers the phrase, but I'll let you decide what the language is. Russia's central bank moments ago, jawboning up a rate increase out there. Ruble moves fractionally from a 75.50 down, breaking through 75, stronger Russian ruble. What kind of language do you expect to see from an American central bank when and if they have to go with the anchor or the unanchored, I'd say?
Well, I think in terms of Fed chatter and what the Fed's communicating right now, I think that all eyes really are on what constitutes substantial progress right now. So, Chair Powell and other members have been pretty clear that the next step on this path to normalization is going to come from tapering. And they've been, in many ways, more vague about what constitutes what they need to see for substantial further progress relative to what they've actually seen towards the Fed funds rate. And so we're looking in terms of whether they're still keeping that phrasing around on track for substantial further progress. And really it comes down to, I think, more so what's happening on the labor market front. We know we're going to get this pop in inflation this year, but that is not the Fed's primary concern. It's really coming down to what we're seeing in terms of the labor market and if that's moving along nicely enough as far as the Fed
and John,
is
what's so
concerned.
important here is wage inflation. We're months from wage inflation, aren't we?
Oh, totally. That's why we're not going to have a conversation about raising interest rates for a long time. And this will come down to the balance sheet. So, Sarah, is this just a case of see you in June?
I think next week's meeting very much is. So I think it's going to be very quiet, non-event. I don't think we're going to get really any change in tone at all coming from the Fed, as much as Chair Powell will be pressed in his press conference. And so I think in every Fed meeting is important, but some more so than others, and this is just not one of them.
Tom's right to bring up the wage issue. Let's talk about the compositional story that I think we'll spend a lot of time on over the next couple of months. What will the wage picture look like with that in mind?
Well, I think the wage picture is actually firming a lot faster than people expected. So yes, we're down about 8.5 million jobs relative to where we were before COVID, but there are pockets that are really struggling for workers right now. And in fact, we're already seeing wage growth firm. Look at what's happened with the ECI in terms of manufacturing, in terms of transportation, in terms of construction. And we get ECI data next week for the first quarter, and I think that'll show that we're seeing wages on that measure, which does control for composition, we're increasing, 2.25%, almost 2.5%. That's, almost a full percentage point above what we saw coming out of the Great Recession. And so we actually are seeing more wage pressures than we have in prior periods. So there's more in terms of labor inflation coming than I think people are appreciating right now.
Perhaps, but the question is for how long, right? Because there are these frictions that people talk about, whether it's leisure trying to bring back workers en masse who perhaps have childcare issues or other things that aren't coming back, or just manufacturing jobs that have ramped up that are going to wane as people go back to experiences. I mean, how much is this temporary and how much is this permanent wage inflation that's structural and speaks to perhaps less slack in the labor market than people had expected?
Well, I think, we tend to see wages move pretty slowly. There's not, in terms of the trend, it's not terribly volatile. So I think the fact that we already seem to find a floor in that trend, it does suggest that we'll continue to see gradual upward pressure. And then I think it also comes back to what we talked about at the start of this conversation, expectations. And so if we are seeing stronger inflation and it does take more for workers to come back, then I think you could see that wage trend continue to move higher.
Meanwhile, we're dealing with a proposal from the Biden administration with respect to higher capital gains taxes that does shift the focus of where the taxes go, that basically push people into spending more on people, on things, rather than just putting their money into capital markets. Do you have any modeling for what this would do to growth, what this would do to investment? Is there any precedent for this type of proposal?
Well, I think in terms of how this could potentially affect the outlook, and the fact that it could help stabilize the deficit. We saw the deficit actually increasing before COVID, and that was really driven by more entitlement spending than anything else. So to the extent that we are seeing plans for spending that actually might go to factors that boost productive capacity in the economy, I think that has a very different implication in terms of how that spending manifests, and if you are actually trying to meet some of that with actually bringing in stronger revenues as well. So I think it really depends on how we are spending, whether that raises the productive capacity in terms of that deficit outlook. And I think when it comes to the focus on corporations right now, it's really a matter of following the money. Labor share of income has been declining since the 70s, and so I think if we are looking at ways to potentially stabilize that deficit picture, you are going to have to shift more towards the corporate side.
Sarah, very quickly here, what do you see on CapEx? What's the Wells Fargo prediction of what companies actually do? I don't buy for a moment there's a CapEx plan when I see the share buyback tone of the first earnings reports.
Well, I think we've already seen a lot of CapEx in many ways pulled forward, at least when it comes to the high-tech CapEx that has helped so many of us work from home. But I think as we continue to see some of these supply constraints affecting more of the good side of the economy, you are seeing some of that more traditional CapEx come back as companies are thinking a little bit more about expanding capacity, because right now for many companies they're losing out on sales because they cannot meet demand. And so I think that helps underpin the CapEx recovery that's already well underway.
Sarah, we've got to leave it there. Sarah House of Wells Fargo on the US economy and the outlook with the Federal Reserve meeting just next week, and the big one, I think, in June when we get a new set of projections. Tom, this coming from Politico. The Democrat from West Virginia, Senator Manchin, endorsing the Republican from Alaska, Senator Murkowski, in a Politico interview. Now, for people in the United States, this won't be a big surprise. We've seen this before with Senator Collins and Senator Manchin. Tom, I think for people internationally, it underlines some of the nuances in Congress this year and going into next year too.
Yeah, it would. I mean, it's a mix here. It's into the weekend. It's into the Sunday talk shows. But it goes, this is important, John. It's not just about Manchin and the circle of senators around him. It's what we heard earlier from Ben about the Georgia senators and getting reelected, not those senators, but other senators getting reelected in less than 2 years.
And Tom, where it leaves Senator McConnell as well, who refused to go forward with a certain amount of checks to be paid out in the late part of 2020. And you just wonder how different it could have been if the focus was on getting that relief package through before those Georgia runoffs.
Within the capital gains and forget about capital gains, just within the general tax policy to come, how do you find a compromise? I don't see that map out there.
Do you think we did get burnt now on the Republican side of things, Lisa, because they went big but not big enough?
I think that this raises questions on both sides of the aisle, frankly. I think that this raises questions for the Biden agenda that's coming fast and furious with a lot of dissension with respect to how to pay for it. And then on the Republican side, it really raises questions about the disparity between their views and, frankly, the popular support for some of the stimulus checks that you're talking about. So how do you sort of toe this line? Is Joe Manchin sort of charting his own territory, his own middle ground, and taking a lot of people from both sides with him?
It's a tough one to swallow, isn't it? Potentially a $1 trillion, close to $1 trillion relief package at the back end of last year that I think everyone's almost forgotten about.
It seems
seemingly
small.
not enough.
Small potatoes.
Isn't that amazing what has changed, Tom, in the last 12 months down in D.C.? I mean, we've reflected on this many times, but I think we have to keep going back to it. We have redefined what a skinny bill is in Washington.
Well, the bills are there. We're looking at the reality of what's been passed and the reality that we have to pay for it. One of the stories, John, into 2022 is going to be the combined deficits of trade and fiscal budget. They're unimaginable right now. Imagine where they're going to be in 6 months.
Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Equity futures this morning bouncing back from a day of losses. Their biggest one-day loss going back to the middle of March. From New York, we're up 9. We're positive 0.2. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Wealthy Americans may want to brace themselves. Bloomberg's learned that President Biden wants to almost double the capital gains tax for those making $1 million or more. When you add in an existing surtax on investment gains, the new top rate could be as high as 43.4%. The proposal could reverse a long-standing provision of the tax code that taxes returns on investment lower than on labor. And that proposed capital gains tax hike is blamed in part for driving down Bitcoin for the 7th time in 8 days. The world's largest digital currency dropped below the 50,000 mark. Bitcoin set its record of almost 65,000 on April 14th. U.S. vaccine experts meet today to review Johnson & Johnson's coronavirus shot. It's been on hold for the 10 days after several cases of rare and serious blood clots. The panel of experts advises the CDC. The 15 voting members will debate whether the shot should again be used in the U.S. In China, President Xi Jinping's next target in the tech crackdown is the country's vast streams of data. China's forecast to hold about a third of the world's data by 2025. Last month, Xi promised to go after platform companies that amass data to create monopolies and gobble up smaller competitors. And Citigroup is about to fine-tune its global branch network. Bloomberg's learned that Citi could fetch as much as $6 billion from the sale of retail banking units across the Asia-Pacific region, Europe, and the Middle East. Citi will now focus on wealth centers across Europe and Asia. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Earlier, there were countries that maybe breathed a sigh of relief that somehow assumed that they escaped the worst of this pandemic. But we're seeing quite clearly that that's very much not the case, that many parts of the world still remain deeply at risk. So I worry about these headlines continuing for a year or more unless international partners get together and help share some of the vaccines that are there.
The reality in America is not the reality abroad right now, specifically in India. And that was Jennifer Nuzzo there, Johns Hopkins Center for Health Security senior scholar. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action. 4 straight weeks of gains becomes a week of losses in America. We take a bite out of that this morning. Equity futures up 11 points. We advance around about 1/4%. Yields are higher by almost a basis point to 154.54 on a 10-year maturity. And finally in the FX market, 120.53 on euro dollar. Positive there by about 1/3%. Just about holding on to that 120 handle through much of this week. That's the price action, Tom. Let's talk about some of the data around this pandemic. Yep. Vaccinations in America now sub 3 million. Just keeping an eye on that as we start to roll over just a touch, not a dramatic move, but sub 3 million. Your daily average now over the last 7 days, 2.95 million, according to our Bloomberg vaccine tracker, Tom.
Now look at its huge success. There's talk about a rollover of vaccines in America, but John, it is a massive statement, not only on the United States, but the United Kingdom as well. Andrew Peckhouse with us after this most difficult global week for this pandemic. He is at Johns Hopkins. Andrew, I do not understand how oxygen is made for hospitals. I'm learning about it. I'm learning about all sorts of regulations and 93% memorandums of how you make the oxygen we take for granted. Why can't we get oxygen to India?
Well, this is really an example of how the infrastructure that's there to support the medical communities is really something that we don't pay much attention to, but is absolutely critical to the function of these facilities. And the surge capacity in many of those networks is simply not there. The profit margins and those types of things really don't drive massive expansion of those networks. And so therefore, when we have these surges that are associated with these cases, you just don't have the ability to increase that flow of essential items as easily as you can perhaps add beds to a hospital or put up a tent and make an area where you can care for patients.
Do you perceive as a grizzled pro that we can ride to the rescue, that the Western world can ride to the rescue of a beleaguered India, or is that just stuff of the movies?
It's good. Anything we can do now will have its effect a week, 2 weeks, 3 weeks from now. So again, I think this is where public health interventions are critical to understand. You have to put them in place sooner rather than later, because it's prevention that we want to work on. And that requires us to really put in the effort before we see a problem to make sure we minimize the problem. And that's where, this is going to be a difficult situation in India. And let's not forget Brazil either, who is also still struggling mightily in the throes of severe cases of COVID-19. These are places where we have to have a global community, because we also have to understand that the viruses that are present there will eventually move out and enter other parts of the country. So there's a second reason to also pay attention to those kind of places and try to get help there as quickly as possible.
Dr. Jennifer Nuzzo yesterday, when she was on the show, was talking about the importance, based on what you're talking about, of the U.S. sharing some of its vaccine with the rest of the world. There is a question, though, about how much the vaccination rate and the high take-up that we've seen already in the United States is slowing the spread here. How effective has it been, given the fact that we still have a pretty high number of infections diagnosed every day?
Yeah, I think you're starting to see the hints of how the vaccination campaign, as it's rolling out to the general population, is working. As I look at the maps of U.S. cases, there are hot spots. There are places where things are getting under control. And again, these are the hints of the vaccination campaign working. We're nowhere close to being at the level of vaccination that would really make a major impact on the case numbers. And so that's why we really need to focus on maintaining the ability to get vaccines into people's arms while also keeping some of the public health interventions in place, at least for the short term, to get these case numbers down.
There was faith when we started this year that we had the vaccines that could effectively stop the spread of this virus. Now we have an uptake that's good, but not great in the United States. You have the pace of vaccination slowing down, and the bar for herd immunity, whatever that is, and you can debate that, is getting higher and higher. And I'm wondering, given the variations that are establishing around the world, are we going to still be talking about this at the end of the year? Are we moving away from our expected goals based on the lack of progress in a number of different fronts?
Well, you know, I firmly believe that the vaccine will get this pandemic under control, particularly when it comes to the very serious disease, the hospitalized patients, the deaths, those types of things. How well we get it under control in terms of it being something like influenza that we have to deal with on an annual basis is really going to depend on the public's ability to line up and get these vaccines. We will be able to protect those that are very high at risk for severe disease. In fact, in the U.S., we've already done a great job of doing that. It's really penetrating into the regular population, the people that don't feel like they're at high risk of severe disease, that maybe feel like the vaccine is not necessary for them, or the people that maybe just aren't completely aware of what an important role vaccination of the general population is, irrespective of personal risks, to provide that protection of the population. So there's a lot of communication that has to get done now.
Andy, before you go, going into the weekend, I think many Americans right now and individuals across this country are facing the same issue. They're going out to eat this evening, and when they go out, as they walk around in the open air, if they don't wear their mask, you get the odd person looking at them like they're absolutely insane, but they've been vaccinated, they've had their second dose, and then they're going to go and sit inside a restaurant and take that mask off and eat. When is the CDC going to come out and make sense of this for everybody?
Relatively soon. Updated vaccination guidelines are currently being worked on at the CDC. We should be hearing about them perhaps as early as next week. I think part of the hesitation for updating those guidelines is that since so few Americans were immunized up until recently, we didn't want to striate the society into have and have-nots and say as soon as you got your vaccine, you could shed all of your public health interventions. So I think as that level creeps up, you'll see more and more ability of vaccinated people to do more and more, and hopefully that can be used as motivation for people who haven't been vaccinated to actually get the vaccination.
Andy, it's great to catch up. Andrew Pekos there of Johns Hopkins Bloomberg School of Public Health. And Tom, that's the problem that some people have with the CDC, is that they're involving themselves in an ethical...
Hello, ladies and gentlemen. Are you ready to trade? I'm placing an order to sell short euro. The price I'm looking to sell, 120.56. Oops, as you can see, we already filled this order. You still have a chance because the price moved up. So if you want to trade euro, if you want to sell short, it doesn't really matter for day traders, short or long. The only matter is if you hold overnight. Am I right? Here is your chance. We placed order and it's already filled. I'll speak to you later. Stay safe.
This is Bloomberg Surveillance.
If you can just scan all the incoming mail, all the incoming luggages, it's going to be a massive time saver. And it means that we can capture a lot more of the illegal wildlife trade that's currently going undetected.
So our focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We still have the long-term structural forces that weigh against significant acceleration in growth.
The markets are so overbought, enthusiasm is so high that I think we're approaching that stall speed for a little while.
The scope for downside surprises in the United States is bigger.
The market is going to have to navigate this transition from incredible monetary accommodation to thinking about what removing some of that accommodation is ultimately going to look like.
Where policy stance is today needs to be seen through, but absolutely there are some tough decisions ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures this morning slightly positive after 4 straight weeks of gains. We head towards a week of losses and a tax proposal, Tom Keene, potentially shaking things up down in D.C.
Well, the taxes are there, and as Ben Laidler says over at eToro, 3 years up, double digit. I guess there's going to be some capital gains as well. We've got an incredibly important interview, John, coming up with Liz Ann Saunders. She's always wonderful. But today, this is absolutely key. John, here's what I think on a Friday. We're beginning to see the earnings season, and I'm going to predict this. We are going to see major reports, some equity strategists today through the weekend and into Monday. You're going to hear from the Dwyer, Constant, Wilson, Saunders, all of them. Martin Adams, all of them. That gang is going to reset this weekend.
Mike Wilson and Morgan Stanley focused on execution risk and higher prices. We've seen that from Procter & Gamble, Whirlpool, Kimberly-Clark, Coca-Cola, all talking about passing on higher costs.
And the dog's doing better as well. John, I know you're riveted by this. I mean, I get emotional as well. It's Ken's 60th birthday over at Mattel. Mattel out with very good earnings here, and handsome Ken doing well for him.
Happy birthday, Ken. Who thought that this is where we'd be, Lisa? Talking about a 60th birthday of Ken with Tom Keene.
I'm going to just hope that that's transitory.
It's not. It's permanent, I promise you.
In honor of the astronauts today, in honor of the astronauts and Ellen DeCosta Benoit feeding them Tang.
There you go.
I always wonder what's in that cup at 7 a.m. Eastern.
I'm sure it's Tang. I will say this, just talking about earnings, there's been a really interesting development, in my opinion. You've seen really good earnings on average. Some misses, and we just got one crossing, which we'll get to. But honestly, for the most part, it's been great. And the response in markets has been, meh, what do you got for us next time? And that, to me, is fascinating. What is driving the market action that we've seen recently, John? Because, frankly, the data has justified some of the moves that we've already seen.
I congratulate you for always doing your best to make this program serious, Lisa. Thank you. And I agree with you. It's captured by the bond market. So let's talk about this market right now. Your bond market on 10s, 154.54, yields higher by a single basis point. This is the third week of gains for Treasury. The third week of yields moving lower over the week. Keep an eye on that. Euro dollar 120.53, up about 1/3%. And there's your equity futures picture. A bounce from the biggest one-day loss going back around about a month to the middle of March. Equity futures 41.36 on the S&P. We're up 9, Lisa, up 0.2%.
Yeah, and I could try to make this less serious and talk about Ken's birthday for the next 30 seconds, but instead I'll talk about what I'm looking at today, which is some of the economic data. 9:45 a.m. we're going to be getting U.S. April manufacturing and services PMI. We got data out of Europe this morning, and I thought it was fascinating. You saw a resurgence in services. Despite all the bad headlines about the spread of the virus there, still people are getting hired as waiters, as people who are serving and doing. And meanwhile, manufacturing accelerated at a record pace there. Expect something similar in the United States. 10:30 a.m. Very interesting to see Bloomberg is hosting a summit on climate. Janet Yellen, Christine Lagarde, and a number of others, including Mark Carney, who was on with us earlier this week, are going to be speaking about climate and capital markets' role in combating some of the carbon emissions that we have seen on an ongoing basis. And then today, CDC is meeting to review the J&J vaccine. This comes 10 days after they initially paused the use of this vaccine. Will they recommend it in a different capacity? And what does this mean in the distribution of J&J? Not necessarily in the United States, because the United States is just fine without it, but internationally, which is in desperate need, John, of vaccines, of a way to curb the spread of the virus.
Lisa, thank you. Some of the things to look out for through the day ahead and the weeks ahead as well in this market. So here's the news. The news is that the President of the United States is expected to propose exactly what he promised he would propose, an almost doubling of the capital gains tax rate for wealthy individuals in the United States of America. Liz Ann Saunders joins us now, the perfect guest to discuss this with, from Charles Schwab, the Chief Investment Strategist. Liz Ann, great to get your time on this program this morning. Just your reaction, Liz Ann, to the news of the last 24 hours that we were talking about through much of yesterday afternoon into this morning.
Yeah, what was interesting yesterday is how many headlines I read or saw or heard that said, you know, Biden will be raising the capital gains tax. And that's obviously not how legislation works. So it's the proposal. This has been telegraphed clearly. A little bit of a shock yesterday, obviously, in terms of market reaction, but it's a trial balloon. And much like with any proposal, you tend to get it watered down as you go through the sausage making in Washington, and there are some moderate Democrats that are not necessarily in favor of significantly higher taxes. So what ultimately this looks like when whatever that is, broadly on taxes, not just cap gains, is probably something different than what sits in the proposal at this point. And then historically, it's just a mixed bag. It really hasn't had a significant impact on the market, capital gains tax changes in either direction. I'm not here to say don't worry about it. It's good for the market, but there's not a lot of indication that it causes serious damage in and of itself to the market. But we'll have to see.
Liz, a lot of our listeners and viewers don't know that you've had a real interest in public policy, including your service to various administrations on fiscal policy. Let me give you a William Gale question over at Brookings. If we raise the capital gains tax, is it possible we'll bring in less revenue?
Well, so that's the theory out there. Some of the math that's been done, and of course it's going to be biased depending on if you're, part of an institute that's more on the right-leaning side or the left-leaning side. But, there was some data out yesterday on an assumption if it goes all the way up to the 43 and change, that would actually be a revenue loser, that there is some point on the scale that maximizes the revenue. And if the goal is to increase revenue, then you should focus on whatever that percentage is. If it's an egalitarian goal, then that's a whole different ball of wax.
When it comes to the markets, though, Liz Ann, a lot of people were saying that some of the highest bid stocks, or Bitcoin, for example, would suffer the most on an ongoing basis as people try to get out, solidify their gains ahead of these capital gains taxes. Do you think that type of selling has legs, that it will continue, or do you think that it was sort of a knee-jerk reaction and, frankly, is a buying opportunity?
Well, I think it's sort of yes and yes, and not so much the buying opportunity. It was a knee-jerk reaction, but that doesn't mean that all the selling is done and that one day gives you an entry point. I think sentiment has been so frothy and so stretched, and we've talked about this before in this program. In and of itself, that doesn't suggest a contrarian move in the economy, but it increases the risk to the extent there's some sort of negative catalyst. That's what happened to a large degree last year. We really frothy sentiment in January and February, and then, of course, we got the mother of all catalysts with COVID. I think this could represent one of those catalysts that could increase choppiness. And to your point, Lisa, I think it does put downward pressure on where momentum is greatest, where gains are most lofty. And you do see that in history. You see some churning, you see a denting in momentum. You do tend to see a bit of a weight on some of the higher valued stocks. And any selling that occurs in anticipation of that, of course, tends to be focused in stocks that have the biggest gains.
Well, Lizanne, putting aside the capital gains taxes for just a moment, we've gotten earnings that have beaten, on average, pretty significantly. They've been very good. What is the market looking to fundamentally? If yes, it is perhaps getting a bit of a hit from this proposal, which is not going to necessarily get passed as it is. What does that tell you about what's driving the market right now?
Well, here's the funny history about earnings and stock market performance. We know they're connected, but there's more of a lead-lag situation than I think people generally understand. If you go back the entire history of the S&P 500, you break earnings into various zones, maybe no surprise, the worst market performance has come when earnings are in total plunge mode, down more than 25%. But once the market starts to price in the inflection point back up, the best performance comes when earnings are still down between negative 25% and negative 10%. It's that acceleration off the lows that gives you the huge pop in the stock market in anticipation of the improvement. By the time you get to more than 20% earnings growth, you're down into the very low single-digit return territory because at that point, the market has priced in the surge. So I think a lot of that is what you're seeing. You've seen a market that over the past year has done extraordinarily well, in part pricing in the earnings growth we're now experiencing.
What's your SPX level out 12 months? I mean, give us the Saunders level of bullishness.
You know I don't do that.
I know, but give me a
like getting
Lizanne, it's Friday. Nobody's watching. Nobody's listening.
I think
they're bickering.
It's of no value to individual investors. I don't know where the market's going to close today at 4 o'clock, let alone
See that, John?
December 31st.
Tom,
I just don't see the value of that exercise.
Lizanne, forgive him. You know, I've done this routine with Tom now for years, and he's still asking you that question. Lizanne Saunders there, Charles Schwab, Chief Investment Strategist. Lizanne, it's great to catch up. Tom, I'll bail you out. We got some news from the ECB from our team over in Frankfurt, Germany.
Lagarde had Ken and Barbie when,
Carolyn Look leading this. I'm going to keep you out of trouble too. The ECB, the policymakers expecting a difficult discussion at the next meeting on monetary policy in June on whether to start slowing their emergency bond buying program. This, according to officials familiar with the internal deliberations. Tom, it's going to get messy over at the ECB. The Hawks versus the Doves, and that's the difference between the ECB and the Fed right now, right? At the Fed, it's about how dovish are you, the scale of dovishness. Over at the ECB, there are still hawks on that committee. They want to wind this thing down.
Yeah, we mentioned that yesterday in our in-depth analysis of the snooze fest. And then Euro moved. Why'd Euro move, John? Lagarde said, we're not the Fed.
They're not the Fed.
The headline was there. You saw it.
Elisa, it's as simple as that. They're not the Fed.
They're not the Fed.
Yeah, well, that means that there's a credibility issue, too, especially of the lack of the cohesiveness. Basically, Christine Lagarde comes out, sings from a very dovish hymn book, and people aren't buying it because of these other rumors and these other headlines that are coming out, John. And I do wonder how much that will undermine her ability to message to this market.
Talks on June 10th will be much more complicated. Officials saying, Tom, they could be heated.
You mean ECB or surveillance?
Both.
Oh, okay.
Yes.
Given how the last couple of minutes went on this
Friday,
show.
I would suggest it's a surveillance snooze fest. I mean,
Is
the
that what
launch
you
was
call it?
great.
Is that what
Keep
this is?
selling it. Lisa Abramowitz,
Tang is
Tom
better
Key,
with ice.
Jonathan Ferro, the Bloomberg
Surveillance
Snooze Fest. Jim Polson in the next hour, Luthold Weeden, Chief Investment Officer. He can't wait to join. Equity futures up 8 on the S&P. From New York City, on radio, on TV. It is Friday, Tom, by definition.
Bobby
This
and
is
Chelsea
Bloomberg.
are celebrating Ken's 60th.
With the First Word News, I'm Karina Mitchell. President Biden is proposing a capital gains tax almost twice as high as it is now. When you add in an existing surtax on investment income, those earning $1 million or more could pay as much as 43.4%. The president wants the increase to help pay for a raft of social spending that addresses long-standing inequality. Meanwhile, Russia is starting to withdraw thousands of troops from areas near the Ukraine border today. Kiev says it welcomes the move and that it reduces tension Western leaders had called on Moscow to pull the troops back. There were fears the conflict could lead to new economic sanctions. Switching gears, Panasonic has agreed to buy American artificial intelligence software developer Blue Yonder. The price tag is $7.1 billion. Panasonic will fund the deal through cash and a bridge loan. The Japanese company already has a 20% stake in Blue Yonder, which uses AI to predict product demand. Daimler forecasts its main Mercedes-Benz unit will be more profitable than it's been in years. That's due to resurgent vehicle demand in the midst of the pandemic. The world's biggest luxury automaker says it expects a 10 to 12% annual return on sales for its cars and vans division. That would be an historically strong showing. And a SpaceX rocket bound for the International Space Station lifted off from Kennedy Space Center in Florida today. It's the company's first crewed trip with previously flown equipment. The Dragon capsule is scheduled to dock with the orbiting lab early tomorrow. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition, weekday mornings on Bloomberg Television.
when you have stimuli of this size around the world, there's definitely taxes coming down the line, whether it's corporate taxes or capital gains increases.
That problem probably wouldn't be good for the U.S. economy.
I think in one sense, a little surprised by the market sell-off. It's certainly not from a high enough rate to derail the recovery.
If a 1% fall in stock prices is all that you get from a really major increase in capital gains taxes, that's not a big problem.
This is a starting point, and I'm sure there's going to be a lot more debate on the conversation.
This is a starting point. Some of the reaction to President Biden's potential tax plan proposal. PGIM's Taima Hayat, Federated Hermes Phil Orlando, Vanguard's Joe Davis, Nobel laureate Paul Krugman, and Chipotle's Brian Nichol. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action. It is a proposal. Liz Ann Saunders re-emphasizing it is a proposal. This is a starting point. 41.36 on the S&P 500. Up a little more than 8 points. Call it 9. We're positive 0.2% on the S&P 500. Yields higher by a basis point at 155.25. Bank of America out this morning, Tom, saying follow the Easter Bunny. The Easter disruptions to retail spending. Don't get distracted, Lisa.
I mean, come on. After Ken, the Easter Bunny, what do you expect?
Let me get to the data.
Carry on.
Total card spending based on the credit card and card data that they track increased 11.5% on a 2-year change for the 7 days ending April 17. Still a good number, but of course fading as we work our way through the disruption of Easter and those checks sent out too. Go to cash on 11.5% spending, Tom.
Yeah, exactly.
It's not
the
bad,
numbers.
is it?
I'm going to go to earnings here, and I'm going to predict again we're going to see a real readjustment in equity strategy in the next 3, 4, 5 days. Right now, Emily Wilkins to translate for us. She's Bloomberg capital gains tax reporter. We're thrilled that she could join us this morning. To me, Emily, the most important person in the block is a gentleman from Western Massachusetts, the 1st Congressional District, Richard Neal. He is Ways, he is Means. He's got 42 members on House Ways and Means. What's the power of Richard Neal and the rest of the Richard Neals on this tax debate?
Richard Neal is an incredibly powerful person for the next several months, and it's going to be up to him to make sure that House Democrats are kept in line as they try to translate what President Biden is proposing into a tax bill into actual detailed legislation. And look, we talk about the Senate all the time and how difficult it is in a 50-50 Senate. Don't forget about the House. Do not sleep on the House. The House has very, very thin margins. You've already seen a number of Democrats come out very upset about the SALT cap. We're watching the reactions today on this new capital gains tax. But like we've seen in the past, some moderates, they're very gun-shy about some of these
gun-shy. Kevin Brady's going to start. Come on, Emily. Kevin Brady of Texas, the minority leader on House Ways and Means, is going to go to Richard Neal, the majority leader, and he's going to say, how many millions do you want to go to the Cayman Islands or the other Cayman Islands out there? I mean, that's going to be the ballet, right?
I mean, to a certain extent here, you mentioned Kevin Brady. He's the top Republican on Ways and Means. But to a certain extent here, how much do Republicans actually matter in this debate? They've already been very, very clear. They don't want to see a change in taxes from what they put forward in 2017. So at this point, the question isn't so much, can we get Republicans on board? The question is, can Democrats actually stay together on this proposal? And that includes the very progressive Democrats and the very moderate Democrats.
The president's shown little interest in uniting Congress over the last couple of months, Emily. He's talked about uniting the country. How do these kind of proposals play out with the country, with the electorate, in polling?
So, I mean, I think raising taxes, it plays out in 2 different ways. I mean, you do see concern from individuals. The idea of raising taxes in the U.S. has long not been politically popular. So I think the goal here for President Biden is to make sure that when he's talking about raising taxes, the message isn't just raising taxes, it's raising taxes on the wealthy. And I think that has a much different perception and opinion with the American public. It's something that President Biden has stressed. I mean, this most recent capital gains proposal, it would only impact those making $1 million or more. That is not the average American out there.
Emily, a bigger proportion, though, of this 0.3% of Americans is actually Democratic. And it's been skewing that way over time, which is sort of interesting. The Republican Party has skewed more populist after Trump's era. How does this play among some of Biden's supporters, contributors, and frankly, for a significant portion, at least when it comes to the money behind it, of the Democratic Party?
Lisa, that's an excellent question, and you're absolutely right in observing that the Democratic Party now does have sort of all these big money, more corporate donors behind them. And you've seen various reactions. You've definitely seen some leaders of companies who have said, look, we need to pay our fair share. This is something that we're willing to do. But you've also heard concerns from other individuals saying this is going to kill jobs in the United States. It's going to kill things like Silicon Valley. And so there does seem to be concern out there. I think a lot of it's going to come down to messaging, and a lot of it's going to come down to who the Biden administration decides they want their electorate to be.
Emily, I know you saw Senator Schumer at Ben's Chili Bowl last night. What is a senator from New York going to do? His constituency, his heritage with Wall Street, what is Charles Schumer going to do?
Well, the thing I bring out here is that President Biden is going to put forward this plan, but then that plan is going to Congress. And at the end of the day, Congress controls the checkbook. They're the ones who write the legislation.
I didn't know that. Yeah.
And they're the, I mean, it's true though.
Just keep going, Emily.
President Biden, Congress has an immense amount of power here at this point. And so I think you're going to see Chuck Schumer, he's going to be talking with this conference. He's going to have to make sure that everyone's on board, and that includes Joe Manchin. So
Absolutely
we might
brilliant.
easily see this number change.
John, this is so important in this day of modern social media and Axios and Politico and all the rest of it. Emily gets back to brass tacks. It's about Congress, not the easy back and forth of social media of the executive branch.
I just couldn't hear Emily at the end there because someone kept standing.
No, she's dead on.
All over her.
She's absolutely
I know
dead
she
on.
is.
I'm sorry. It's about old fogies at the House Ways and Means Committee going, really?
Just usually you ask a question and you let the other person talk for a little bit.
Oh, no, it's my new strategy.
It's new. It's new. Okay.
Can I get some more ice in my tang?
Emily, thank you.
Adds
Emily
a lot of
Wilkins.
energy.
Emily, thank you so much. Bloomberg government reporter down in Washington, D.C. The Japanese Prime Minister speaking right now. He will make an overall decision on when to lift the state of emergency in Tokyo, which was implemented in the last 24 hours, implementing policies to stage a safe Olympics inside 100 days away from those Summer Olympics, Tom. Things are getting dicey in Japan.
Yeah, they're getting dicey, and you see it with the Singapore. I think you're the one that mentioned it yesterday, John, how Singapore shut down flights to India. I mean, I don't want to equate what's going on in Japan to the horrific tone in India and in Brazil for that matter. But, you know, we go into this weekend, John, and it's this, I mean, where's the rest of Europe now? I sort of was shocked where my math on France was.
Improving slowly on the vaccination front, that's for sure. The Japanese Prime Minister speaking to reporters in Tokyo concerned the virus surge could spread, Lisa, across the whole country.
It's important not to conflate what's going on in Japan, though, with India and Brazil, because in Japan, this is an issue of 1,000 or so cases that are being diagnosed. Talk about the U.S. way beyond that, and trying to prevent some of the humanitarian crises and prevent the transmission from increasing dramatically. In India, in Brazil, we're talking about variants, we're talking about mass death, we're talking about suffering on a scale that is shocking and very distressing.
Very, very different levels of tolerance through this whole pandemic over the last 12 months. Lisa Abramowitz, Tom Keene, Jonathan Ferro. This is Bloomberg Surveillance. Priya Misra of TD Securities will be joining us shortly. Equities up 8 points on the S&P. We advanced 0.2% on radio, on TV. This is Bloomberg Surveillance.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The weekly run of gains is about to end. We're heading for a week of losses on the S&P 500, taking the smallest of bites out of that, up about 9 points on the S&P 500. We advanced 0.2%. The Russell right now doing nicely, up about 16 points or so, advancing there by about 0.7%. Switch up the board and get to the bond market. I want to look at treasuries, I want to look at bonds, and I want to talk about the data on either side of the Atlantic. Better in America, the realized data, we've been anticipating it for weeks and months now, and yields have been heading lower for another week. We're down around about 3 basis points on a week on a 10-year to about 155. Bonds are stable at about negative 26 basis points. Lisa pointed out the upside surprise on the PMIs out of Europe. Got to keep an eye on that and what it means for this bond market, because so far, yield action has been pretty muted off the back of that data. What does that look like in the next couple of months if the vaccine progress continues and the data starts to pick up as well? So switch up the board. Investors are still apprehensive. That is the view coming from Stephen Gallo of BMO. And what is the best barometer of that, Tom Keene? It is Euro Swiss. And that's what I want to look at right now. Euro Swiss, just over the last couple of months, has just been flattening out, stalling, in line with what we've seen elsewhere with treasuries. We had that big lift off the back of euro weakness, Swiss weakness rather, Euro Swissy pushing out in February, in the middle of February, Tom, and then we've just started to stall.
Yeah,
and the idea being, as you know, Tom, if investors are less apprehensive, the Swissy should be weakening up more. And right now, we're not seeing that.
Well, the stall is really important here. I'm glad you bring up Euro Swiss. We haven't talked about it in a while with a 1.10 and just sort of stuck there. But, John, it goes to the miscalculations of, we figure with the calendars. We go to the end of the year and all the certitude we had in equities and the certitude in bonds, and we're all rewriting the script into this weekend.
I did that just so we could have a moment, so we could reminisce and talk about the times we used to talk about Euro Swiss in Zurich.
Well, there was that,
together.
That lunch that we had at Brasserie Lip. I remember,
from Davos to Zurich.
Swiss went.
Drank tank together.
I got a great video of you in a bar, a couple of hours deep into drinking, that I'm still tempted to put out on Twitter.
I can't believe where, my indicator is what does an Hermes bow tie cost there. It's outrageous how expensive Zurich is.
It's about 2 a.m. It's the middle of the night.
Is this blackmail?
I lost Tom in the restaurant, so I walked out to try and find him. And I found him in the middle of Zurich, just looking around the outside of art galleries, just peering into windows, strolling around, and it was freezing.
Looking around corners.
But Lisa,
he was looking around corners.
What he doesn't say
he was looking around corners.
I'm on the phone doing math homework back in America. I mean, Lisa, that's...
Okay, to be fair to you, that's not untrue.
It's like, I'm sorry.
That's not untrue.
X is a variable.
But after that, there was another bar, so we'll leave that one there. After we did the homework. Romain Bostic, get Tom out of trouble.
Oh,
Okay, I want to hear the end of this story at some point, but I guess we'll take a look here at what's moving here in the pre-market.
With a bow tie today for radio.
Absolutely. I'm wearing the Tom Keene Memorial bow tie. Rest in peace, my friend. American Express moving a little bit lower here. We did get earnings this morning here. They did miss on revenue, so the shares are down about 3.4%. They did beat on the bottom line, that EPS, but that was largely because of a pull forward of some of those lost reserves that they had set aside previously, about $1 billion there. The story of the day really has to be what's going on in the chip sector. We did Intel earnings last night. Those shares moving lower here in the pre-market, down by about 2%. It's really all about that data center business. Year-over-year revenue dropped about 20%. This is a company, it's almost like a castle out there that's just really just getting bombarded on all sides. You got Taiwan Semi, you got NVIDIA, AMD, Samsung, all sort of chipping away at Intel's business. It continues to lose market share.
Well said.
In fairness to Pat Gelsinger, he's only been on the job really for barely 2 months or so. So he's obviously, give him a little bit of time to try to turn the ship around. But this is a company that's just
what else do you have?
Incredible competitive environment. Skyworks Solutions, Tom, have you heard of them? This is a big deal.
No, I have not.
Huge Apple supplier. About 70% of the revenue comes from Apple. Big deal last night. They're going to buy Silicon Labs infrastructure and automotive business. And this is key because investors say they were too tied to Apple, too tied to the iPhone. They needed to diversify. This gets in there. This is a lot of the sort of AI stuff that will go into cars and your smart refrigerator that I'm sure you have at home. Flip up the board here. You take a look at what else is moving. Snap, digital ad spending. It is alive and well. Revenue per user for Snap going up, and that's why you're seeing the shares here up 5%, $59.90 on the day. Pinterest, Twitter, a lot of the other digital ad space companies also moving higher. And remember, we get earnings from Pinterest and Twitter next week, and of course the granddaddies next week, Facebook as well as that other big one.
That's where I want to
Google.
go. I mean, come on, Romain. We got a huge earnings stream to come. What have you learned about earnings season now? And I would suggest equity strategists have to reset this weekend after what we saw with Danaher, even Intel, sort of kind of like okay, and some other earnings like Mattel that were really good.
Really good, but you're dealing with three factors. You're dealing with obviously a pull forward from the pandemic. You're dealing with a much different competitive environment for a lot of these companies, not just in the chip space. And then on top of that, you're dealing with this cost issue. I mean, we had the CEO yesterday of both Dow and Chipotle, and they're both dealing with the same thing, and that's rising costs, obviously for different reasons for both of those companies. But this is a big deal that you're hearing from a lot of companies. Those margins have been under pressure for a lot of these firms. What they forecast on that is going to be key.
Into the weekend, the close this afternoon. It'll be interesting here, and as Romain says, huge earnings stream next week. Right now in the fixed income space, John, I want you to bring in Priya Misra with TD Securities, because on a full faith and credit basis, we are at a surprising point this late April.
Yeah, a really difficult point that people are really struggling to read. Let's bring in Priya Misra of TD Securities. Priya, the data's better, yields are lower, and everybody's scratching their head trying to make sense of it.
Right. And that's been the biggest question, is the move over. Well, we would argue, if you decompose the decline in rates, it's all been led by real rates. So I think the markets finally heard the Fed, that the Fed is going to be extremely patient, that they're going to see actual data, not just forecasted data. And so therefore, with the Fed controlling the front end, not even talking about tapering, I think that limits how much rates can rise. But when we look ahead, there's a lot of supply. We have auctions next week. We have data that's going to continue to look better. We do think that rates are going to continue to head higher. So I'm still looking for 2% on the 10-year by year end.
So you don't think we've tested the tolerance, really, of this market, this economy, at 175, 177?
No, I think... particularly when we look at real rates were not that high, even in the move. Much of it was inflation expectations. So therefore, and you look at broader financial conditions. I mean, that's what the Fed's looking at. Broader financial conditions are still extremely easy. So when you talk about testing, I would look at real rates closer to 0 on the 10-year. I think that's a level where the economy shows signs of stress and financial conditions start to tighten. That's when the Fed will step in, but we're pretty far from there.
Priya, can 10-year Treasury yields rise to those levels, to your expected 2% by year end, if we don't get a commensurate move of any sort over in Europe, over in Japan? In other words, can the U.S. go it alone with rates increasing on the longer end without a similar move elsewhere?
Great point. I think, global rates do provide sort of a soft ceiling on the 10-year. But how wide can that spread go? We do expect bonds to sell off a little bit, but we expect treasuries to really underperform. I mean, but there's a limit, right? Because if the Japanese investors can come into treasuries, European investors will find better yields in treasuries. So I think it's important to look at global rates. We are a little heartened by the fact that the PMI data is coming up a bit better. The pace of vaccinations picked up in Europe. So expecting some lift in those European rates over the course of the year, and that's going to allow treasuries to continue to rise in yield.
On a technical perspective, we've seen that institutions, pensions have been rebalancing into treasuries. You've had buying not only from overseas, but also internally to try in the U.S. to try to capture these yields, to lock them in ahead of what some people think is going to be turbulence in risk assets. How much does that buying suppress yields and sort of act as a cap, at least in the near term, to how high rates could go?
I think there is some of that, absolutely. We've seen treasury stripping data going up. And so I think if in isolation, that would have potentially put a cap to how steep the curve could get. But here's the issue. The U.S. Treasury is issuing 20-year, 30-year, 10-year. They're issuing a lot of long-end paper. And we don't think they're going to start to cut back any of that, particularly if you're going to get another $4 trillion of overall fiscal package. So, I think the pension buying helps, and it limits how steep the curve can go and how high long-end rates can go. But I don't think it's enough to offset all the treasury supply that the market will have to take down over the next few months.
Priya, we've been wrong so far on a big move in inflation, a big move in rates. What will be the catalyst to finally get rates move? Is it something about economic data, or is it more about the financial system?
I think it's about sustainability. I mean, it's the T word. It's how transitory is this. What the market, I think, is trying to grapple with is we know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists. Does behavior change? Do we all start using up, pent-up savings? And is that reopening related pickup in growth? Does that translate into a sustained increase in demand and a sustained increase in inflation? And that's what the Fed's watching for as well. We're a little skeptical that you'll get this massive pickup in catch-up service spending over the next year. If you didn't take a single vacation last year, do you take 4 vacations this year or 6 vacations? Unlikely.
Well,
so, we still have a bit of a muted growth, but I think that's the key question.
I think someone in the Keene household is trying, Priya. Someone's trying to get 4 vacations this year. TK's under pressure.
I can't do 11.
Priya Misra, TD Securities Global Head of Rate Strategy. Priya, great to catch up. Priya's final point there, Lisa, I think was really important. Jared Woodard of Bank of America also making that point. The degree to which the savings rate will come down, the savings that were accumulated through much of last year, how much they will be pared lower as well. There's some real debate around that in this country.
There is, based on the fact that people put a lot of that into savings, a lot of the money they received, and perhaps some of it will go to deferred mortgage payments, deferred rents. That said, there is so much cash out there. I mean, if you take a look at the excess cash on balance sheets globally, some people peg it at $5.4 trillion. If even a fraction of that goes into the market, how much does that generate growth? How much does that generate inflation? And these are some of the debates people are having.
Wasn't it Chairman Powell that said you can only have 1 dinner? You can't go out for 2 dinners. Isn't that what he said?
Do you agree?
Something like that.
I've had 2 dinners before, have you?
You can't have 3 vacations, Tom. 4 vacations.
Do you know I have 47 days left for the year?
Is that how much vacation you've got?
Yeah.
What are you going to do with it?
I think October looks good.
I don't think it's you that gets to decide, to be honest. I think we both know who decides in your household where you're going next. Coming up, Pierre Ferragu, New Street Research Head of Technology Infrastructure. Need to talk about the chip business and what it means for manufacturers in America.
Yeah, we do.
Autos, very much at the center of that conversation. Yields are higher by a basis point on a 10-year to 155.25 in the FX market. Euro dollar 120.60. Positive 0.4%. That is a stronger euro again. In the commodity market, up about 0.5% on crude, approaching a 62 handle at 61.75. And in your equity market, 4 straight weeks of gains, potentially a week of losses following that. We are down on the week. We are up on the session. 8 points on the S&P, up by 0.2%.
We've cratered.
Heard on radio, seen on
John,
TV.
we're down 1.4%.
From a beautiful New York City. Ignorance is bliss.
Just keep going.
This is Bloomberg.
With the First Word News, I'm Karina Mitchell. wealthy Americans may want to brace themselves. Bloomberg's learned that President Biden wants to almost double the capital gains tax for those making $1 million or more. When you add in an existing surtax on investment gains, the new top rate could be as high as 43.4%. The proposal could reverse a long-standing provision of the tax code that taxes returns on investment lower than on labor. And that proposed capital gains tax hike is blamed in part for driving down Bitcoin for the 7th time in 8 days. The world's largest digital currency dropped below the 50,000 benchmark. Bitcoin set its record of almost 65,000 on April 14. Meanwhile, U.S. vaccine experts meet later today to review Johnson & Johnson's COVID-19 shot. It's been on hold for 10 days after several cases of rare and serious blood clots. The panel of experts advises the CDC. The 15 voting members will debate whether the shot should resume in the U.S. And Japan is set to begin a state of emergency Sunday in Tokyo, Osaka, and 2 other prefectures. It will run until May 11th. The measure calls for the closing of bars and restaurants that serve alcohol, establishments with karaoke equipment, as well as large commercial facilities. Coronavirus infections hit daily records this month in Osaka. And Deutsche Bank will allow its U.S. interns to decide if they want to work from home or be in the office this summer. They'll be able to choose whether they participate in the program purely virtually or come into the office 3 days a week. Deutsche Bank says they'll get the same quality of training, whichever method they select. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Trading revenues coming in better than than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
COVID caused everybody to step back a bit from capacity and build out and the supply chain of the industry, and it induced a radical increase in demand. So you have supply chains scaling back a bit and demand scaling up radically. Wow, and now we're in a position that there's a meaningful shortage. And, you know, it's going to be a couple of years until that's fully resolved.
Wow is the right word. That was Intel CEO Pat Gelsinger there on the situation with chip makers and chip supply worldwide. From New York City, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's your equity market this Friday morning, shaping up as follows. Up 7 on the S&P. We advanced 0.2%. In the bond market, yields are higher by a mere basis point to 154.72. Euro dollar positive on the day, stronger by 0.4% against the dollar for the euro. Euro dollar 120.61. And just to round things out, Tom, crude 61.69. Up about 0.4%.
61.69. What we'd like to do here on surveillance, folks, Lisa, John, and I like to speak to true experts on what it is out there. There's a lot of back and forth, a lot of opinion, but you need to get authoritative at some point. We can do that with Pierre Ferragu. He's at New Street Research, but what that doesn't describe is his legendary work at BCG and then at Sanford Bernstein, where he was definitive in writing black books on the silicon wafer industry. Mr. Ferragu joins us today from, again, New Street Research. Pierre, good morning to you. Why is there a shortage of chips?
Oh, that's a combination of a lot of factors, and I think as Pat explained well yesterday, we are, you know, in that kind of world we started anticipating in our black books 3 years ago, where demand for chips is actually accelerating. There is an inflection point that is driven by artificial intelligence and the fact that we now have use cases where the more resources, the more chip, the more processing power you throw at services, at problems, the better outcome you get. And this has been accelerated by COVID-19. We are way more digitalized today than we were a year ago. Mm-hmm. So COVID-19 accelerated demand. And at the same time, COVID-19 broke down supply chains, got people scared. The auto industry last summer, everybody would agree, including us, that it would take years for the auto industry to get back to the level of demand pre-COVID. And what happened? That demand came back actually in a matter of months, if not a matter of weeks. And that caught people on the wrong foot by surprise. They were reducing orders, whereas they should have doubled orders in order to meet the effect of COVID-19. So that's a combination of these two things.
The elasticity here of the market between supply and demand, the worry has always been about wafer size. We're never going to be able to make enough silicon wafers for global Silicon Valley. Is the microeconomics of your world in good shape right now, or is it broken?
Oh, in our world, it's in extremely good shape. You never want something more than a situation where demand is growing, supply is running behind, and the CEO of the largest company in the industry explains you the situation is not going to get better, is not going to get fully resolved before a couple of years. So we are in a world in which capital inflow is massive. Everybody's increasing capex, $30 billion at TSMC this year, $20 billion at Intel. And on top of that, let's see what the memory makers say, but I think they're going to increase their capex very significantly as well. And on top of that, the leaders of these companies are telling you there is no quick fix. We are not going to fix that relatively quickly. Well, so that's an extremely strong macro backdrop, and we are very well positioned in the cycle for that.
Pierre, it's not going to get fixed overnight, and there has been a lot of talk, whether it's Intel's investment in a foundry in the United States, China's investing heavily in this. Is this enough to move the center of gravity when it comes to chip production away from Taiwan? That's
an excellent question. I'll tell you my gut feel. I hope it is. I hope, the industry takes this opportunity to make that happen, to get like a TSMC fab in the US, a competitive one up and running, maybe to get Samsung build like a leading edge fab in the US as well. And most important, Intel being successful in their strategy shift, developing a model where they're at the same time an IDM and a foundry where they offer their clients to integrate their IP into chips designed by their client on their foundry, and even maybe offer an alternative to TSMC and Samsung as a foundry, as a place where you can have any leading edge chip manufactured. Now this is a challenge. We are talking, the entry ticket to that game is $20 billion. It's 3 years. It's monster investment, and the proof of concept has not been made. We need to get Intel to be able to offer these services in a competitive and sustainable way. We need TSMC to find out a way to run a fab in the US away from their natural ecosystem successfully. This is going to be tough. It's a very significant investment in dollar terms, but also in time. It's going to take a long time. And so I think like the silver lining of this environment is that makes the environment very supportive, that encourages the US governments and many other governments in the West to be supportive of the move. And what's very interesting is to see also that potential clients of these new fabs, these new foundries, are very eager to mitigate their exposure to the geopolitical risk in China.
Pierre, just real quick here. I mean, Intel does have this problem where they're direct competitors of the companies that they're hoping to make chips for at their foundry. And this does raise questions about whether people will be reluctant to do business with them. Are there any other companies that could potentially provide some competitive feel for TSMC based on their standing and their investment capital?
So, the simple answer is probably not. You have a couple of additional foundries, in particular global foundries, but these are players who gave up on the leading edge already a few years back. And the leading edge is this moving target that is making progress every year. And so in that club of people who can manufacture at the leading edge, you have TSMC. You could almost say it's only them as a foundry. There is Samsung, who is trying to offer an alternative, but it's challenging for them. And then you have Intel, who has gone through challenges as well, and is doing that only for their internal demand. And outside of that club, you don't really have people who could easily step in at the leading edge.
Pierre, we've got to leave it there. It's always got to catch up with you, sir. Next time, we've got to talk about Tesla too. Pierre Farago there, New Street Research Head of Technology Infrastructure. Need to bring you some headlines as well. The first of those headlines coming out of Russia. The Russian opposition leader, Alexei Navalny, ending his hunger strike. The latest out of Russia, some tension over that issue over the last couple of weeks, that's for sure. Also in Europe, Ursula von der Leyen, the leader of Europe, Tom, confident we can vaccinate 70% of adults in July. That's the timeline for the Europeans right now.
Yeah, 70 is the important number there. That's a big number. There's just no other way to put it. I mean, as you've led on, John, there's been a real shift there, but 70% is not 60%. It's a big number.
It's got to happen. It's got to happen quickly, and that's the target. Alongside us, Lisa Abramovitz, Tom Keene, Jonathan Ferro. This is Bloomberg Surveillance. Your price action, your equity market up 7 points on the S&P. We advanced 0.2%, 154.54. The real yield will be coming up a little bit later on Bloomberg TV at 1 p.m. Eastern Time. Interesting to see the ruble gaining against the US dollar off the back of that Navalny headline.
Higher yield.
From New York, this is Bloomberg.
There is renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We still have the long-term structural forces that weigh against significant acceleration in growth.
All eyes really are on what constitutes substantial progress right now.
The markets are so overbought, enthusiasm is so high that I think we're approaching that stall speed for a little while.
The market is going to have to navigate this transition from incredible monetary accommodation to thinking about what removing some of that accommodation is ultimately going to look like.
Where policy stance is today needs to be seen through, but absolutely there are some tough decisions ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. It's a simulcast radio, television. I mean, the gloom in those opening montage, the gloom measurement, John, off the chart. John, I'm looking at Dwyer talking about stall speed. The Standard & Poor's 500 on a daily basis, it craters 1.32%.
Any assessment at any time is always relative, Tom, and it's relative to really, really good numbers that we're posting already, and a belief that maybe those numbers are as good as it gets. But these numbers are still going to be great for the next several months, and that's the reality of the situation in America. We're opening up even more, getting back to business, Americans getting vaccinated. The domestic story's been improving for a long time now.
We could sit on this and on the wonderful research this morning as well. Futures up 9, Dow futures up 21, NASDAQ up 32, small caps up 0.8%, the VIX 18.19. You know what? All that matters, John, is what Steve Englander said at Standard Charter. We're creating millions in jobs.
Cumulative gains. That's what we need to talk about, Tom. Even if we've seen peak rate of growth in America already this month, maybe next month, the cumulative gains this year will be tremendous and hopefully taking inflation up because unemployment's been driven lower. And that inflation is going to be fueled by higher wages. That is what we're hoping for. That's the optimal outcome, right? that we get a tighter labor market and higher wages.
We don't need a Gini coefficient to know, Lisa Abramowitz, that the inequalities are here. I mean, they are tangible. The president's mentioned them. It's the politics of the moment. The fact is it's a boom economy, Lisa, for some.
It's a boom economy for some, and this, to me, is sort of the interesting development. You started out by saying the gloom crew is out. The gloom crew for what? For markets, not the economy. This had been the opposite at the end of last year, right? We were talking about how markets were kind of disconnected to the ongoing pain that we were seeing in the real economy, people not in work. The reverse is happening. We're seeing better than expected data, better than expected earnings, and perhaps people are resetting in markets, and in the economy, it's just taking off, Tom.
And I would look at for the two of you, John, pick up on this. One of the observations off the map here, as we saw Trudeau speaking at the president's summit, was his colleague, Chrystia Freeland, really showing the partition of job formation in Canada, which is real jobs growth, and the distinction in America is we're just catching up. We're just replacing what we lost from the pandemic beginning.
And the composition of the job losses in America is very specific as well. And I think we saw a perfect example of that 12 months ago when wages actually surged higher because the lower earners came out of the workforce. We're going to see the opposite maybe in the months to come. You've got to reverse engineer that. As for the gloom crew in this market, can you identify anyone on the south side that has changed their view of the year ahead in a tremendous way?
No, but they've reaffirmed, and I'm predicting, John, they will reaffirm this weekend.
That's what I've seen.
They're going to watch the real yield at 1
stayed at 3,800. Mike Wilson and Morgan Stanley stayed in and around the same number, 39, 4,000. We've seen the same 4,300 from Goldman. I haven't seen big changes.
Hold on a second, though, because it's not just the headline. It's also the composition of those gains.
But their view on the composition of the gains hasn't shifted.
Not that much. No, you're right. But the reality is, what has changed in the actual data that we're getting? If anything, it's actually exceeding expectations. So what people are reassessing is perhaps the longer-term view, which is confirmed by treasuries and yields going lower, that inflation isn't going to materially shift higher as a result of some of the spending.
Before we get to Jim Paulson and a wonderful conversation here on where we are, John Farrow, the salient point for me Wednesday, Thursday, and Friday is we're seeing an earnings reshuffle rather. Joe Feldman over at Telsey takes Amazon and reaffirms a $4,000 price target this morning.
Here's the brief from Jonathan Golub at Credit Suisse. Just dropped into the inbox just to wrap up earnings. And Lisa touched on this a little bit earlier this morning. 25.7% of the S&P's market cap has reported Q1 results. Earnings have surpassed estimates by 23.1% in aggregate. 83% of companies topping projections. Financials exceeding forecasts by 37.4%, while the rest of the market is beating by 13.4%. Really decent Q1. The individual that has pushed this story forward on the south side, I think, has been Mike Wilson and Morgan Stanley. Might not have moved his headline number for year-end on the S&P, but Lisa, to your point, where he has pulled back is on things like the small caps, and he's talking about execution risk. Execution risk after raising the bar, focused on cost, input costs, and the ability to actually meet the better demand in a big way.
The change here, to me, is how long this cycle can run, right? And I think that that's where Mike Wilson has really shown a real brilliance. The idea, but the idea of it runs hot and it runs hotter than people were expecting, but shorter. And that, I think, is what the call is, this mid-cycle kind of call, moving away from some of the cyclical trades from earlier in the year.
What is so impressive here, Jonathan Farrow, Lisa Abramowitz, and Tom Keene talking about 42 people, all within the same 3 zip codes. We joined James Paulson with the Luthold Group, way outside of our 3 zip codes when he joins us this morning from Minneapolis. Jim Paulson, you're listening to this Wall Street blather. What do you observe in the Midwest?
Well, I think the thing that impresses me the most is a little bit what you're talking about is how much the economic reports coming out are just exceeding everyone's expectations, Tom. I looked at the Bloomberg U.S. Economic Surprise Index, and that has been in the upper quintile of its history now, 80% of the time in the last 12 months. And there's nothing like that in its history, even close to that. We've just chronically been outpacing expectations. You know, last week was a great example. When the retail numbers came out, everyone knew they were going to be a blowout, and yet, even though the estimates were really aggressive, we blew those numbers away. And Jonathan was just talking about earnings. When you're in top quintile economic surprises, future one-year estimates on Wall Street go up at about a 17 to 18% annualized pace. When you're in the middle three, they go up about 5%. When you're in the bottom quintile, they fall 5%. So earnings estimates are chronically being upscaled because we're just being bombarded with economic information that shows that conditions are better than we thought. And if earnings estimates are going up, I think it's going to continue to drive target prices up as well. And to me, that's the biggest thing. We just can't catch up after going through a depressionary bust with this health crisis to suddenly having a runaway bull market. No one can believe that we can do that within 12 months, and yet that's exactly what's happening. We just can't catch up to it.
Jim, you know how this works. As always on Wall Street, price just sets narrative. If you get 6 months of gains and we carry on ripping, people will keep extrapolating that out. But when you start to stall for a couple of weeks, a couple of months,
that's right,
people start to think there's a change in the trend. What does the price action tell you, Jim?
Well, you know, Jonathan, there's certainly been, I would say there's less pause in the trend of the overall market than there is a go and a stop in the parts of it. I think that's a sort of an interesting dynamic. I'm amazed by how much gloom there is about the market when the market's only a fraction of a percent away from all-time record highs. But underneath that, what I see happening is if rates go up, then tech stocks get hit, and the cyclicals and smalls are doing well. And then when rates stall out, the cyclicals and smalls pull back, but tech comes back. It's a consistent force here for the market when different parts are driving at different times.
And what's so important here, Lisa, we're showing for radio, we're showing a chart of the Standard & Poor's 500. Lisa, it's a gloomy chart.
Yeah, it's to the moon, Jim, which raises a question. You know, people are talking about gloom, and you rightly pointed out we're talking about gloom with a 0.9% pullback in one day, and it's the most in months or a month, and people are concerned about it. Is this enough to be buying, given the fact that there are people who are saying that there's going to be turbulence, who are pairing some of their risk positioning? Is this a place to continue to buy, or do you sort of take a pause yourself to try to figure out how things are going to shake out in the next couple of months?
You know, Lisa, I fully expect we're going to get a correction, you know, on the overall S&P 500 this year, 10 to 15%. And I don't know when that's going to happen. I think it's going to be really difficult to call that. I still suspect it might come from higher levels yet sometime later this year, but I don't know. But here's what I would say. We've already had, you know, some pretty reasonable corrections going on in parts of this market, in small caps, in cyclical sectors, in emerging markets. I would take advantage of that. Rather than run from those right now, I would actually go to those if you haven't been there. If you take small caps, if I look at the relative performance of small cap stocks historically, three things line up really well with it. Real GDP growth, bond yields, and commodity prices. And right now, when I look at every one of those, real GDP growth, yields, and commodity prices, I think almost everyone would say they're going to go higher in the next couple of years. And if they do, there's really good bets that small cap stocks are going to outperform. And here's an opportunity where they've pulled back. You could say the same things about emerging markets or cyclical sectors. I think all those things got more life to them on a relative basis over the next couple of years, even if we go through a correction phase.
5% off the highs at the middle of the March on the Russell. Hey, Jim, always refreshing for someone to say, I don't know, sometimes, and just say it on air. Almost cathartic, isn't it, Jim, just to say it sometimes. Jim, it's great to catch up. It's good to see you. Jim Paulson, the Luthold Group Chief Investment Strategist. We are up still, even with that 5% pullback on a small caps, by almost 46 percentage points from the start of November, off the back of that first headline around the vaccine progress, Tom. Just a remarkable rally still.
Well, so the rally's there. You know, we make, you know, John, let's be honest. We make jokes about it. A lot of people have participated in this great bull market, but I'm daily stunned by the number of people that in whatever way really haven't participated in these gains. I mean, there's a whole shtick here.
Totally.
I'm in the triple leverage, all cash. The amount of gloom that has not allowed people to participate over what's pushing 14 years has been extraordinary.
I remember Neil Dutta of Renmac, middle of April, I think it was, recession over. Do you remember that call? And everyone just thought, whatever, Neil. Everyone started pushing back.
That's
we spent
exactly
the next 2 months worried about retesting the lows, and this market just kept ripping.
And to Jim's point, I'll note, John, last weekend the Gloom Crew was out in big force.
From New York City this morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Futures up 7. On the S&P, we advanced 0.2%. Heard on Bloomberg Radio, seen on Bloomberg TV from a beautiful New York City. This is Bloomberg Surveillance.
With the First Word News, I'm Karina Mitchell. In Russia, jailed opposition leader Alexei Navalny says he's ending his hunger strike. Navalny began refusing food 24 days ago. That sparked concern he could die in prison. Navalny gave up the hunger strike after he was allowed access to outside doctors. Meanwhile, President Biden is proposing a capital gains tax almost twice as high as what it is right now. When you add in an existing surtax on investment income, those earning $1 million or more could pay as much as 43.4%. The president wants the increase to help pay for a raft of social spending that addresses long-standing inequality. European Central Bank policymakers expect a difficult discussion when they meet in June. Bloomberg's learned they'll be deciding whether to slow their emergency bond buying program. Some members are ready to argue the program should start being scaled back in the third quarter because the economy will likely be improving. Others want a more cautious approach. And Panasonic has agreed to buy American artificial intelligence software developer Blue Yonder. The price tag, $7.1 billion. Panasonic will fund the deal through cash and a bridge loan. The Japanese company already has a 20% stake in Blue Yonder, which uses AI to predict product demand. And a SpaceX rocket bound for the International Space Station lifted off from Kennedy Space Center in Florida today. It's the company's first crewed trip with previously flown equipment. Dragon capsule is scheduled to dock with the orbiting lab early tomorrow. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is something that Biden had said all along he was going to try to do, and now he says, I'm going to try to do what I promised I was going to do in the market. Although, you know, we get, if a 1% fall in stock prices is all that you get from a really major increase in capital gains taxes, that's not a big problem.
That's what you get from a proposal, not from actually realizing that proposal. That was Paul Krugman, the Nobel Economic Laureate from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's the price action. Equities okay, up 7 on the S&P. We advance about 0.2%. Yields higher by a single basis point, 154.37. And euro dollar just through the week, clinging on to 120. We advance 120.64. Tom, up about 0.4%.
Nice little lift this morning as well. We'll watch that through the day here as we reset for the weekend. We get your reading ready for the weekend, and much of that reading will be on the tax policy to pay for all of this debt and pay for our growing deficit. Laura Davidson is with Bloomberg Tax, and she last night moved the markets and moved the world of Washington, where they're reporting on a very large capital gains tax increase. Laura, in your reporting and preparing your very important breaking news, what was the hardest thing to confirm within the reporting?
Well, the hardest thing is, are they going to go with that top rate, north of 40%? Because that was really the issue. Is there's this Obamacare tax, a legacy tax that's on the books that applies basically to all capital gains. So there was a lot of question, both within the reporter community as well as within the White House, of do you stack those two rates to have a rate that is north of 40%? And ultimately, that's what they are going to go with.
Laura, how realistic is this based on the support that there is or isn't in Congress to get passed?
This is something that Democrats are interestingly pretty united on. Republicans, of course, have said they're not going to vote for any tax increases. Republicans really aren't part of the discussion here. But going forward, Democrats are largely for taxing those, making $1 million or more at a lot higher rates. The question is, we haven't seen some of the more members that can be a little more skittish, Joe Manchin, Kirsten Sinema, they haven't come out yet and commented on this proposal. But this is an area where I think that we could see significant movement. If not, a 40% rate, something less. These are all open to negotiation as this moves through Congress. But Democrats, at least directionally, are marching in the same way.
Laura, are these tax hikes going to be linked to the $2.3 trillion infrastructure plan, plus, I should say, that Biden has put out there, or is it going to be attached to additional spending plans that we're expecting in the upcoming months?
So Biden next week is set to put out this American Family Plan. This is sort of a follow-up to his infrastructure plan from last month. They're calling this a human infrastructure plan, so it's for things like childcare and education. Congress has not yet decided whether they're going to move these two packages together or separately. The infrastructure package is funded by corporate tax increases. This family plan is funded by individual tax increases. That's really a question for Congress, and really a question of, can they get all of this stuff done in separate bills, or do they have to cram it all into one big bill at the end of the year?
Laura, what would you presume what I'll call financial Democrats will do? Let's start with Chuck Schumer of New York State and of Global Wall Street. How do they respond to the size, the scale of this ask?
Well, this is certainly an issue that Schumer's going to be hearing from on both sides. So they're really looking at the comprehensive picture here of, what are the tax increases on corporations? What are sort of the whole suite of tax increases on individuals? Capital gains is just going to be one piece. There'll be higher income rates, a more broad estate tax. There's also a lot of discussion on what is going to happen with SALT, or the state and local tax deduction, which is a big deal for New York, New Jersey. This really gives people who want to get a bigger SALT deduction some more leverage to say, hey, we'll pay a little bit higher rates, but we really want this deduction back.
Our Justin Fox has a wonderful and very comprehensive essay out on the confusion over our tax policy. Do you presume that the politicians in Washington are clear thinking, or are they going to be confused as they get to the first Tuesday of November over this issue?
I think it's fair to say on most issues that people are more confused than not when it comes to taxes. Yeah. But looking at this, this is one issue that, the New York, New Jersey Democrats have said, look, the SALT deduction is hurting the middle class. And what the Justin Fox piece shows is really no, the people who are getting hurt by SALT are the really wealthy, the super wealthy, not kind of your upper middle class. He calls them the Henrys, high earners, not rich yet group. And then this is something that's really been kind of obscured in the data, but, there's a very clear effect there. And that's going to be something that they're going to have to contend with as they continue to push for this. The politics are just very, very tricky.
Laura, what's the analogous historical period for these capital taxes? Basically, is there a time in history where we saw those taxes raised, imposed, and then the commensurate growth or lack of growth in the economy that's being used to highlight this issue?
Well, this is something that we really haven't seen yet, having capital gains and income taxes at the same rates. You go back in the 19-teens, there was a period where those rates were equalized, but we haven't seen that in basically 100 years. And this is what Republicans point to, is saying, look, this is going to dampen economic growth. This is going to discourage incentives to save and to invest in the future. And this is something that Democrats are sensitive to and going to be watching the economic indicators going forward.
Laura, before we let you go, I think a lot of people are trying to work out whether this would be retroactive to this year. Would it be?
So Congress technically can make it retroactive. The administration and Democrats in Congress have said that they prefer prospective tax policy. So the thinking is this would go into effect January 1 of 2022. However, nothing has been decided yet. Nothing's final.
Okay, well, tremendous reporting, as always, Laura, with you and the team. Thanks for catching up with us. Laura Davidson there, down in D.C. on a Bloomberg team with some breaking news over the last 24 hours, Tom, that shook this market up just a little bit.
Yeah, well, the market, shaken up, there's no question about it. I mean, you look at the taxes, it's really substantial. John, we've avoided Super League chat. Let's change that right now.
Thanks.
Our good friend, James O'Neill, Lord Jim O'Neill, writing with Paul Marshall, Sir Paul Marshall, a letter to Joel Glazer, and there's just no question about this. To paraphrase a lengthy letter, you seem to have been persistently out of touch with the culture, spirit, and purpose of Manchester United. You should shift share ownership, commit £10 million to charity. Paul Marshall, hugely visible in charity in your United Kingdom. And then, John, this was biting. You presume there was trust.
Yeah.
John Farrow.
The duo, of course, longtime fans at a club. And you'll remember, Tom, back in 2010, the Red Knights Consortium, does that ring a bell?
Little bit.
Reportedly tried to buy the club back in 2010. You do wonder whether that's back on the table with maybe Jim O'Neill and friends again. I have no idea. But you do wonder how the dominoes fall from here, because I don't think we're done yet for some of these big clubs. And I will remind people as well, it's not over for the likes of Barcelona, Real Madrid, AC Milan, Juventus. They have not given up completely on this one, Tom. They're still trying to work out how to pick up the pieces. And those pieces are very much on the floor at the moment.
And the pieces in the coming days, John, let's go out 1 week, let's go out 10 days. Can some of these teams be precluded from playing in Europe?
I don't think so. I don't think that's the direction of travel right now. I think if they carry on pushing this issue and try and establish this league, then yeah, sure, we could end up there, but not right now. What's going to be interesting for me is how the likes of Barcelona, Juventus, Real Madrid, and AC Milan reconvene and what the next steps are for them, because quite clearly the trajectory of spending for those clubs in Europe is not sustainable.
This is really important. The one thing I've learned out of this, folks, and I'm as ignorant as this as anybody. I sound like a know-it-all. I don't have a clue what I'm talking about. Our David Hellier, John Farrow, talking about the losses taken in the recent years by these teams.
Yeah.
Unreal.
Elisa nailed it earlier this week. Debt. There's a lot of it. From New York City this morning, good morning. Alongside Lisa Abramowitz, Tom Keane, I'm Jonathan Farrow. Your equity market improves a little bit, up 0.1% on the S&P, snapping back from yesterday's losses. Selling the program hard, Tom. Nice, beautiful. This is Bloomberg.
Famly's flagship store in New Delhi. The iconic British toy store chain is set for a revival as the new owner and billionaire Mukesh Ambani looks to expand the brand in India. Planning to quadruple the number of outlets in India to 500 in 3 years. The expansion of Hamleys will help Ambani widen his retail portfolio as he transforms the oil and chemicals conglomerate into a consumer and technology giant.
No, I think certainly it is gaining popularity since last few years, and now more and more people are coming to Hamleys because it has a wide range of toys for all the age groups.
Founded in 1760, Hamleys has been struggling to make profit for a long time, and the pandemic has worsened its financial distress. The deep pockets of Asia's richest man and India's demographics could help Hamleys revive sales.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Let's whip through some of the price action cross-asset worldwide for you. Here in the United States, equity futures are positive by 4 points on the S&P 500, up about 0.1%. Down yesterday, biggest daily loss going back to the middle of March. On the week, off by about 1.2%. We take a bite out of that weekly loss, just a little bit going into the open. Switch up the board and get to the bond market. 2s, 10s, 30s. I'll whip through this and rattle through the numbers for you. Yields 153.49 on 10s, on 30s at about 222. Upside surprise on the PMIs out of Europe earlier this morning. US PMIs coming in about 1 hour and 15 minutes. In the FX market, going into that number, euro dollar looks like this. Euro dollar clinging to a 120 handle through much of this week, and that is where we stay. North of 120 on a single currency, north of 120, going in potentially to some better data out of the Eurozone, Tom, and that's what we're hoping to see in the weeks and months to come as the vaccine progress continues to make progress.
This is a theme this week, and it's picked up by Zurich-based UBS, Union Bank of Switzerland, saying Europe looks good. We check in on a Friday where we all reset, we readjust with Evan Brown of UBS Asset Management. Evan, thank you so much for joining. Let's go back to Brown Economics 101, which is you have to partition goods and services. You're right that goods are strong, but services will show dispersion. Discuss.
That's right, yeah. So as we reopen, there are different paces of reopening across the world. And I think the services sector in the U.S., that rebound is broadly priced at this point. But what is less priced, becoming more priced, is this European rebound. That, as you say, the vaccination pace is accelerating, that we're going to get, Europe is just a few months behind the U.S., but that is the big story now. That is why the euro is going up, and that's why we see European assets outperforming.
You know, your colleague Luke Kawa is centric on the Toronto Maple Leafs. Oh, how dare I misspoke, Luke. Okay, great. But the news this week was out of Canada, Evan Brown, where Christian Friedland said employment formation is different than in America. Is America creating jobs, or are we still in a replacement of pandemic mode?
It's a great question. We're still replacement of pandemic mode. I mean, most of the job gains you're seeing are in that in-person service sector, and we have a long way to go, but it's actually moving pretty fast and set to. We'll see a million job gains coming up pretty quickly, and a move towards full employment over the next 12 months or so. So it's coming, it's happening. It's happening a little bit quicker in Canada, and that's why you see them as the leading central bank removing some policy accommodation. But yeah, U.S.
John,
we're coming back.
I think this is a great insight on Friday. We've got Russia on the edge of taper, and we've got Canada, as Mr. Brown mentions, Canada on the edge of taper.
These central banks have different reaction functions. The reaction function of the Federal Reserve is markedly different after the shift of the last 12 months. You mentioned the cumulative gains through the year ahead, Evan. Here in the United States, we could be at full employment at the turn of the year. I mean, what a recovery that we're discussing. So from your perspective, this concept of peak growth that I think there's been a massive debate on in America, in markets over the last couple of weeks, what is more important from your perspective, your standpoint, for capital allocation? Peak growth or cumulative improvement through the next 12 months?
Yeah, that's a great question. So cumulative improvement, when we talk about cumulative improvement, Europe actually has in a deeper hole, right? Has a larger output gap, has been hit harder by COVID. That output gap is going to close more quickly, actually. And so because of that deeper hole, more to come, more rebound to go. And so that's why we're in this view that Europe can outperform on an asset price perspective, is that faster rebound that's not quite priced.
They have a longer runway, and you want to play this through equities and the FX channel too, Evan?
Both. I think the cleanest way is to do FX is relative growth differentials. With Europe and U.S. equities, it's more of a value versus growth story. But still, European equities should outperform. I mean, I think the one thing is just the improving economy, but also as we talk about these tax plans in the U.S., I mean, markets shouldn't have reacted so much yesterday. It's broadly in line with what Biden has proposed. But tax hikes are coming. We should know that. The market is clearly vulnerable to those headlines, and those are coming. Whereas in Europe, actually, you don't have the tax headlines, and you actually politically see a move towards the greens, which could set the stage for more expansive fiscal policy going forward.
Evan, there's a controversial premise underpinning your comments, which is that markets have already priced in the entirety of policy support in the United States of not only the $1.9 trillion stimulus, but any additional stimulus plans that might get passed. And you put in your recent report that such proposed policies would likely be more beneficial for the U.S. economy than U.S. markets. How widely held do you think that belief is? Or is this actually somewhat of a contrarian view?
No, so I think people are getting more excited about this rotation out of the U.S., but I don't think it's quite fully embraced at this point. I mean, the fiscal that we're going to get out of the U.S., we've had the pure fiscal, we've had the pure sweet, right? The upcoming fiscal is going to be sweet and bitter. We're going to get the tax hikes with the spending, and by the way, the spending is set out over a number of years, right? So the U.S. story gets more complicated from an equity point of view. We've seen from yesterday it's not quite priced on the U.S. side, but Europe is just we've been in peak pessimism. It's beginning to heal right now, and as much as people are warming to that story, it's not fully priced in at this point.
So there's a difference between underperformance and losing value. Do you think that the U.S. and riskier assets there are poised to lose value or simply underperform Europe and other areas that are further behind in their recovery?
Yeah, exactly. I don't think losing value. I think just much slower pace of returns that we've seen. So, which is not exactly controversial, right? We've had a 10, 11% gain in the S&P 500. I think we can expect as growth matures that we're going to see less upside going forward. But yeah, as we so it's still we're still moving through this recovery. We're still seeing upbeat growth. The pace of change is moderating in growth, and so will do so in asset markets. But as you move from early to mid cycle here in the U.S., slower pace of returns, a lot more room in the rest of the world.
Evan Brown, is cash an asset?
Cash is certainly an asset. I mean, we've seen it before, right? Bonds and equities can sell off at the same time. And if we do get into a world where we don't just have this 2Q bounce in inflation that everyone is expecting, the question is it transitory or is it more sustained? If it does turn out to be more sustained, which we're very open-minded to, then you could be in a situation where the Fed surprises people, tapering earlier and a faster hiking pace, and then you've got the pressure of bonds selling off and equities selling off at the same time. That can get pretty ugly, and in that situation, you want to have an adequate exposure to cash. I don't think it's the time right now, but certainly down the road, that's the risk.
Evan, always great to get your views on a show. My best to the team. Evan Brown, UBS Asset Management Head of Multi-Asset Strategy. Just on the road ahead, the path ahead, and this relative trade between the United States and Europe, which I think has got a load more attention over the last several weeks, just as we start to make some progress on the vaccine front over in the Eurozone, on the continent, in Europe.
We started, John, with Win Thin, talking about emerging markets. And I mean, you wonder, do we shift back to where we were 6 months ago? And part of that is the percolation in Europe.
Certainly one thing that's shifted just markedly, Lisa, in the last 6 months has been this move away from this big, fat, one-way, synchronized global growth trade. There is so much more dispersion now worldwide, not just the divergence between Europe and the US through Q1, but elsewhere outside of Europe too.
There also was a bit of complacency that we were going to exit the pandemic with relative ease, that basically it would just be a matter of time and then we would be done with it. That's being called into question just by the nature of the infections in certain places. We talk about India and Brazil. And you look at, for example, the International Airline Association coming out and actually increasing their potential losses for the airlines this year. John, there is a feeling that these losses will be ongoing and perhaps haven't been adequately figured for. It is a more complicated recovery than just synchronized.
It will come in waves. Couldn't agree with you more. It won't happen all at once. And you mentioned the airline business. Tom, the airline business this week has just captured the story so well, I think, between a domestic story which has recovered and recovered fast on the leisure side, and the international story, including big business too, business travel, which continues to struggle and perhaps will do into year end.
You put out the news on a Friday afternoon when nobody's paying attention, like the snooze fest at surveillance. And the answer is, John, what does the United States International Air Travel Authorities do this weekend, given India and given what we just heard from the leadership of Japan?
I agree with you. At the same time, we need some real guidance from the CDC as well, Tom, about what you can do if you have been vaccinated. If you have been vaccinated, can you go? Can you travel?
Well, you know, you mentioned this. I mean, with the space program, the crew 2 that's going up has been vaccinated. John, the crew coming down from the space station has to quarantine because they haven't been vaccinated.
Well, okay, quarantine from what, the space station, in case there was anybody there with COVID, really? And look, just away from that.
I'm sitting here laughing. Later on this evening, Americans across the country will go out for dinner. And I mentioned this earlier. They're going to walk around outside and will get strange looks because they've got a mask on or haven't got a mask on. Then they'll go inside and have a meal and take those masks off. And many of those individuals have been vaccinated, and hardly anyone out there can reconcile why they're allowed to go inside and take the mask off and why they're getting funny looks because they're not wearing a mask outside. And we still haven't clarified an issue which should just be common sense now.
It's a tricky issue. And yes, the science does suggest you could take the mask off and go around and do your business. But the anecdote that Dr. Jennifer Nuzzo highlighted about this nursing home where there were people who were unvaccinated who worked there, and they infected residents who were vaccinated, and one of them died, raises questions about the potential protection, raises questions about the ability to have the virus and pass it on. There just still are unknowns scientifically. The question is, where do you err in the risk sort of spectrum? Do you say the risk is people aren't going to get vaccinated because they don't see the benefit, John?
Well, I don't think we want the scientists to get involved in ethics. And that's the issue that I have with some of the conversations going on at the moment, Tom. And we've seen that repeatedly over the last several weeks as well. The scientists just need to tell us what they know and leave the ethics elsewhere.
You may get it today. I think you make some good points, John. And, you know, the day's young.
Maybe the day is young. It's good to be with you, Tom. You've been on fire today.
I have been.
Yeah, I know.
Spiked tang.
About the dispersion of tang.
I'll see you later on tonight. I'm sure you're going to have a long one. I might drop by and catch up with you. Where are you drinking tonight?
What?
Where are we going?
I got tang going.
Okay.
Yeah.
From New York.
Tang.
This is Bloomberg.
Astronauts, their first nap's 2 p.m.
With the First Word News, I'm Karina Mitchell. Wealthy Americans may want to brace themselves. Bloomberg's learned that President Biden wants to almost double the capital gains tax for those making $1 million or more. When you add in an existing surtax on investment gains, the new top rate could be as high as 43.4%. The proposal could reverse a long-standing provision of the tax code that taxes returns on investment at a lower rate than on labor. And that proposed capital gains tax hike is blamed in part for driving down Bitcoin for the 7th time in 8 days. The world's largest digital currency dropped below the 50,000 benchmark. Bitcoin set its record of almost 65,000 on April 14th. In other news, U.S. vaccine experts meet later today to review Johnson & Johnson's COVID-19 shot. It's been on hold for 10 days after several cases of rare and serious blood clots. The panel of experts advises the CDC. The 15 voting members will debate whether the shot should resume in the U.S. American Express posted first quarter revenue that missed estimates, and charge card fees rose at the slowest rate in at least 9 quarters. Still, Amex was encouraged by lower than expected losses on its loans. That allowed the company to free up more than $1 billion in reserves it had previously set aside. And there's a sign that Intel is losing market share to rivals, and customers are designing their own components. The biggest chip maker reported a drop in data center revenue, plus a steep decline in gross profit margin. Meanwhile, the PC business performed better on continued demand for laptops running Intel processors. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy, and we need companies to step up.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Big tech such as Alibaba and Tencent are no doubt national champions, but now China is stepping up oversight. Just how far will the Chinese government go on regulation? We'll explore on a Bloomberg special, Red Lines, China and Big Tech.
If you look at all the data points of in any country in the last 100 years, when the money supply has increased at that level, you have gotten inflation, 95, 98% of the time within a year or two after those kinds of massive increases. So I think there will be inflation.
An important voice there on our nation's economy, on the formation of capital, and of course on sport. Mr. Pagliuca of Boston and the Celtics, no doubt in the Super League and the disaster seen by the Fenway Group and the rest in America. With David Weston, Bloomberg Wall Street Week, look for that with Stephen Pagliuca coming up. Right now, this is really, really, really important because they were out front and early. David Rich is at Mount Sinai, his leadership with Mount Sinai Queens as well. And they've been out front in the pandemic with the sirens on the Upper East Side, with the agony of their staff getting through the last 14 months. And now the celebration that we're beginning to see that, yes, things are better. Yes, things are, quote, almost over. Dr. Rich joins us for an update. David Rich, what is the almost over measurement right now as we go into a wonderful spring weekend? Can you call pandemic ending soon?
Well, I'm not quite that optimistic, Tom, but I think we're moving in a great direction here. The peak that we saw in the New York region in the second wave in January has gradually come down, but it's coming down at a much slower rate than what we see previously. What we're seeing in our health system is that now there are between 200 and 250 patients. The number varies a little bit day by day. And the peak was somewhat over 500 in January. So it is a very slow decline, but we're learning to manage and to live with this disease in our health system as we try to do everything else to maintain the health of New Yorkers.
Dr. Rich, we've been talking about CDC guidance around people who have been vaccinated and guidance in terms of what they can and cannot safely do. And there is a question of whether their decision is being driven from a scientific basis or whether it's being driven from a political basis to get people to do things in a certain way, to message that there isn't a bifurcation in the haves and the have-nots. What's your view on science's role in dictating based on both the science as well as the political and ethical methods that are going on?
I think that the role of science is to provide data, but also let's not forget that there is a branch of medicine, medical ethics, that also has very important things to say. And I believe that medical science, medical ethics can inform public health officials, including the CDC, as they make very important decisions. I was impressed by reading the New York Times article, I think just yesterday, about a concept of a 2 out of 3 rule, where we consider indoor versus outdoor settings, vaccination status, distancing, masking as very important ways that we can move forward. And I expect that we'll see evolution in the way that our states and and frankly the federal guidelines evolve as a greater proportion of the population is vaccinated.
Dr. Rich, I've got to go to your direct skill because it's really important right now. And this is, of course, the hematology of Thomas Jefferson, the Cardezza Foundation. Your opinion, please, on the blood study of the Johnson & Johnson vaccine.
The blood, I'm not sure which blood study you're referring to.
The clotting worries of the J&J. My fault, I'm sorry.
Yeah. This is a very, very rare phenomenon. It's actually interesting. As a cardiac anesthesiologist, we know a variant of this type of problem very well over the years, a syndrome called heparin-induced thrombocytopenia, which is where a drug that we use to thin the blood and prevent clots to facilitate heart surgery causes a rare immunologic reaction, which is the same thing, antibodies to a type of platelet receptor, PF4. And when that happens, it's a paradoxical thing because it causes clots, as we've seen some very severe clots in the brain, and potentially in other parts of the body. But it is so exceedingly rare that I'm very optimistic that the CDC, ACIP, the group that advises the CDC on immunization, will probably proceed with a warning saying there is a very, very rare risk, but the real risk of dying from COVID probably vastly outweighs the risk of this very rare hematologic problem, perhaps, by a millionfold. We'll have to see exactly what the scientists that advise the CDC come out with.
So in the times of past of diphtheria and typhoid, we just said shut up and take the vaccine, take the medicine, take the antibiotic, whatever. What will be your prescription for our viewers and listeners once we get done with the CDC study?
Well, as someone who's followed this, I am an advocate for vaccination, and I think that although it's always challenging in society to make things mandatory, perhaps in certain employment settings, especially where there's higher risk, we may as a society decide that mandatory vaccination is a reasonable thing to do in certain circumstances. Already, certain educational institutions are thinking about what it means to come back onto campus for students and potentially requiring vaccination for all students. So I think we already see examples of that in society.
Dr. Rich, thank you so much. With Mount Sinai this morning, and of course with his expertise on hematology as well. Lisa, it's just so good to speak to these people with true inside expertise.
It just highlights how we are in the fastest and broadest experiment in medical history in some ways. And it's very fast moving, and you're right to emphasize the success, the incredible successes behind some of the vaccines. We could see the success being borne out in earnings. I do want to just bring up some tidbits from the earnings that we keep getting. American Express saying that vaccinations are beginning to boost travel. We know that Bank of America has done incredible work sifting through some of the credit card spending and how much it's picking up as people get vaccinated. The other interesting thing that caught my eye, Kimberly-Clark, remember when they surged because everybody was hoarding toilet paper?
Yeah.
It turns out people don't need as much toilet paper anymore because they're not worried about Armageddon. Toilet paper sales are plunging. You can now find it in your grocery store. And so Kimberly-Clark is cutting their forecast as a result of this. It just sort of shows the reverse of what we saw during the pandemic, Tom.
I know. Go to cash. I mean,
go to toilet paper.
Go to toilet paper.
Yeah, exactly. You're going to store it with your lumber.
Euro 120.75 top ticks this morning with a stronger euro. That means weaker dollar as well. We'll have to follow that through the day. We've got much more coming up through the day. Just, I said it's a snooze. At least it's not a snooze fest. There's actually a lot going on.
I actually find this a fascinating inflection point because we are dealing with bond yields that have really gone down dramatically from their peak point recently, dramatically within relative speak. But this idea of have we reached peak optimism of U.S. exceptionalism? And that is really the issue that people are facing right now as they try to price in faith because the earnings have been way better than expected. The economic data better than expected. What are people going off of?
And Evan Brown at UBS really underscoring their look to Europe as well. We will look to climate change this afternoon. John Kerry has been on the plains. He's also been Zooming with the leaders of the world. It is a leaders summit for the President of the United States. And his special presidential envoy on climate change will speak to our David Weston. Look for that this afternoon in the 3 p.m. hour. Red and green on the screen, but with a little bit of an upside tilt to it as well. Much more coming up. I must draw your attention to the real yield. You'll be able to see that this afternoon and out on digital media later today.
Still negative, just by the way.
Good morning.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City, for our audience worldwide, good morning, good morning. The countdown to the open starts right now. 30 minutes away from the opening bell with equity futures positive about 0.1%. We begin with the big issue. President Biden seeking to double the capital gains tax.
The market didn't respond well.
This raise in capital gains tax.
It's certainly not from a high enough rate to derail the recovery.
There may be a short-term reaction.
Equity sentiment does appear to be stretched.
It makes perfect sense that you're seeing some indigestion.
Whether it's corporate taxes or capital gains increases.
It isn't unexpected.
When you have stimuli of this size around the world.
True fiscal package still in the pipeline.
There's definitely taxes coming down the line.
We ran up a heck of a set of deficits.
At some point, this spend needs to be financed.
Over the long term, it shouldn't have too much of an effect.
Markets will adjust and recalibrate.
We don't think it derails the the equity market recovery.
That's the debate right now. Let's bring in the Bloomberg team, Emily Wilkins and Katie Lyons. Emily, our team doing the reporting down in Washington, D.C. on this. Walk me through the proposal and when we can expect to hear more.
So the proposal is to raise the capital gains tax to 39.6%. Jonathan, as you point out, that's almost doubling of what it was before. This is going to be a part of a larger package of tax plans that the Biden administration is going to roll out. We're expecting to hear more April 28th. That's when President Biden will be giving a joint address to Congress. He's going to lay out both the tax plan as well as sort of the social human aspect of his big infrastructure push. Expect things on child tax care credits and education.
Emily, the reaction from Republicans, predictable. What's the reaction from Democrats?
So we're still monitoring the Democrats this morning to see exactly what the reaction is going to be. Big name to watch, Senator Joe Manchin. Remember, the past is a little bit instructive here. When President Biden came out with his increased corporate tax rate, Manchin said, hold on, too high, and then sort of picked a number in the middle between what Biden was proposing and where it's currently at. So he could do something similar here with the capital gains tax. Remember, this is ultimately somewhat in Congress's ballpark. They're the ones who are going to have to pass Biden's proposal. We could see that number that he's put forward change in the next several months.
When would it be effective? Would it be retroactive? So many details. Can it even get through? Emily Wilkins down in Washington, D.C. on the latest. Katie Lyons for this market. Equities moving one way in the last 24 hours, just a little bit lower.
Yeah, John, to some extent, this shouldn't have been all too surprising for the equity market, considering this was an issue that the president campaigned on. It was part of his platform, but the size of the hike seems to have taken investors by surprise. We saw a sharp leg lower on the back of this Bloomberg scoop yesterday afternoon, the S&P 500 falling as much as 1.2%, ending up with the worst session in about 5 weeks. But the move was still less than 1%, John. In the grand scheme of things, the losses were not horribly dramatic. Today, futures are modestly positive. The market really just seems to be weighing the likelihood that this plan actually becomes a reality. Now, even if it does become a reality, in the longer term, this may not be a huge deal for the market, in that, yes, returns are usually lower, even maybe negative, in the 6 months before a capital gains hike. That was the case in 1972, 1987, 2013. But in 1987, for example, while the index fell about 3.5% ahead of the hike, it rallied more than 23% in the 6 months following. So it was just a temporary hit in the grand scheme of things, just as yesterday's decline were really just a blip in what has so far been a positive April. Stocks, bonds, commodities, they are all down on the week, but all of those assets are still up on the month, John. To this point, the everything rally is still intact, John.
Kelly, thank you. The president's set to propose exactly what he said he would propose. Let's bring in Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, emphasis matters. We're moving away from pure deficit spending and we're talking about pay-fors. How important is that?
I think it's important because it's also being accompanied by a change of emphasis from favoring capital versus labor to favoring labor versus capital. So there's a couple of things happening here, John, but it shouldn't come as a surprise. This was very well signaled.
The supporting capital versus labour, let's build on that, Mohammed. It should not be a surprise. Are we assessing how successful they can be with that effort? We're aware of the effort. How successful can they be, and how would you measure success?
So, John, how successful is not in the hands of the administration. It's also in the hands of Congress. And this is really tricky for the administration right now. So, a lot of people, for example, don't expect the capital gains tax to double. They think by the time you finish the congressional process, it will be less than that. So the administration will not get all it wants, but there is a clear change in emphasis going on. And it's one that the marketplace hasn't fully embraced yet, but it should.
My colleague, our mutual friend, Michael McKee, pointing out the important clarification every time we talk about the doubling of the capital gains tax is for people who make more than $1 million, Mohammed. So when you think about it that way, what are the consequences of this in your mind, at least from a market's perspective?
Short-term turbulence, and that's it. You may get some people accelerating their sales, booking their profits early, but it's a once-and-for-all effect. It's going to happen, and then we will go on. This is not going to have a major impact on the markets, nor will it have a major impact on the economy. What people are worried about, John, is that this may be a catalyst for something larger. That's what the concern is. Not as a standalone, this is not a big issue. It's just that prices are elevated and people are worried that something may cause the beginning of an unraveling. I don't think this is it, but that's what the concern out there is.
Mohammed, when you say a catalyst for something larger, the something larger piece of that sentence, what do you mean by that?
So we have been in the midst of a liquidity paradigm that has been fully supported by policy, whether it's monetary policy or fiscal policy. They have fully supported the market's embracement of a liquidity paradigm. And that's why you got, just as we heard, the everything rally. When you hear something like the everything rally, you know it's about liquidity. And what the marketplace is worried about is what disrupts that liquidity paradigm. Could it be the Fed? Could it be the federal government? And they're looking, and the concern out there is that this may be the tip of the iceberg. That's what it is. But I would keep an eye on the Fed. I think that's a much more important influence than what happens on the tax side.
Well, do you think what is happening on the tax side is a reason for the Fed to carry on keeping its foot down on the gas, Mohammed? The reason I ask this is because they've been accused of exacerbating wealth inequality. And if you can do something on the capital gains side of things, does that take some of the heat off them for stimulating asset prices?
No. Look, first of all, what they're going to do is they're going to keep their foot on the accelerator. We're going to hear next week upgrading of the outlook, and that's it. Nothing, we're not going to hear anything on measures. So they are going to remain as is, and as Rich Clarida said on your show 10 days ago, they are outcome-based, not forecast-based. So they're not going to change for a while. So they will continue to try and boost asset prices. As to what can they do about inequality, not very much. The fiscal agency can do something about inequality, but the only instrument they have is operates through the asset markets, which by definition worsens inequality.
Yeah, so let's get to the market question, Mohammed. Can you envision a situation in America where we have a year of incredible growth, stellar growth, and unemployment plunges through the year into 2022, and equity markets don't perform at the headline level?
It can happen, John. We've had the opposite. We've had the equity market doing really well when the real economy was suffering. And again, it goes back to liquidity. Liquidity has completely decoupled market action from what's happening in the real economy. So to answer your question, it really is about liquidity. Will liquidity continue to be the great disconnect, or are we going to have something else happening?
Well, the great struggle is not what to do with the equity side. The great struggle over the last month, I think, Mohammed, relatively speaking, more so is what to do with the bond side of the equation. We've had some really decent data in the last couple of weeks in America, in Europe for that matter, on the PMIs as well this morning too. Yet yields have been grinding lower for 3 straight weeks. That's going to be a big theme of this program and on Bloomberg Real Yield a little bit later on in the afternoon. Mohammed, I'd love your take on that. What's been going on? Better data, but lower yields.
So the lower yields don't come from the data. As you point out, the data is not just better, it's better than expected. So the data continues to beat on the upside, and that's wonderful. It is some moderation in inflation expectation on the back of what the Fed has been saying. But I think Priya Mishra was absolutely right earlier when she said it's about flows. We have seen from equities into bond rebalancing, we have seen liability matching flows, and we have seen foreign buying. So we should never expect yields to move in a linear fashion. Like her, I do think we are going to head back towards 2%, but it's not going to be linear. You're going to have these waves of buying as people try to take advantage of a local high in yields.
It never is. Mohammed, it's good to catch up. And I know you're in quarantine in the UK, so stay safe, sir. It's good to see you. Mohammed Al-Arian at Queen's College, Cambridge today. Let's turn now to some of the price action, shall we? Equity futures there are up by about 0.1% on the S&P 500. At the market desk with your movers, I'm pleased to say. Guest assistant today, Taylor Riggs. Hello, Taylor.
Surprise for a Friday. Hey, John, let's take a look at some of the downside movers today. American Express getting worse, of course, as we near that opening bell. Again, the top line revenue looking worse than expected. They released $1 billion in reserves, so that's helping the bottom line. But remember, this is the worst gain in credit card fees going back in 9 quarters. Also moving to the downside, Intel, we did this after the bell yesterday. The CEO saying that chip shortage may last more than 2 years, that data center revenue falling 20%. Still really big concerns about that foundry, how long that is going to take, how do you get customers, and how do you do it better for those customers. Moving higher, of course, Skyworks. This is interesting. Purchasing Silicon Labs for $2.7 billion, all cash offer. We know that means they are signaling confidence in gaining those synergies. They don't want to share the upside. Let's talk about that upside. Flip up the board. It is all about some of those social media companies. We did Snap yesterday. User growth, revenue coming in up 66%. Analysts wanted 50%. So you're really starting to see them be able to monetize that revenue. That pushes us forward. The optimism, the read through to pins, Pinterest, Twitter, Facebook, all of which we'll get next week, John.
Taylor, thank you. Speaking of next week, up next on the program, the inflation debate heating up ahead of that Fed decision next week. That conversation up next with BlackRock's Marilyn Watson and Christian Müller-Glissman at Goldman Sachs. Looking forward to that. 19 minutes away from the opening bell. Equity futures taking a bite out of a weekly loss on the S&P 500. It is a small bite, up 3 points on the S&P. We advance a little less than 0.1% from a beautiful New York City. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
What we see is probably a peak inflation in the second quarter, and then probably in the U.S. 2.3, 2.4% core, and then normalizing towards 2%. So we don't see, there is always a possibility of sustainable research in inflation. It's not our core scenario.
A diplomatic JP Morgan, Dan Pinto there, saying he believes price pressures will be transitory. Investors looking ahead to inflation data next week, as well as the first quarter GDP read and a Fed decision. Busy week next week for Michael McKee, our international economics and policy correspondent. Morning, Mike.
Good morning, Judd. Well, we've been talking about inflation, and that's going to be the theme of next week's numbers, in particular with the Fed. Commodity prices are up. Energy prices are up. We're seeing shortages of supplies as the economy reopens, and the Fed is looking at this, as Dan Pinto, transitory. But how will we know if it's not? Well, one of the things that the Fed is going to look for, and I'm going to bring back a phrase from the 1970s, a wage price spiral, where workers demand more money because prices are higher, and then companies raise prices to cover those additional wages. Before the pandemic, average hourly earnings were running at about a 0.2 a month rate forever, it seems. We weren't seeing any kind of major increases in what people were making. Now, leave aside the right-hand side, because that's the pandemic, and as the low-paid workers lost their jobs in restaurants, etc., we saw average hourly earnings go up because of the average difference change. So it's going to be a while till that works its way out of the data, but as we settle out, we can see if workers are demanding more. And it appears in one area they already are, leisure and hospitality. Restaurant workers going back, but looking for more money. Look on the right-hand side how that curves up. It may be because they're seeing a problem with being in a job that is very close personal contact, and they want more money to make up for the danger. Do restaurants then make up for that by raising prices on their menus? That's the kind of thing that the Fed's going to be looking for. And how will we know if the data is distorted? As I suggested, we talked yesterday about market expectations. Today, we'll talk about consumer expectations. The Fed's going to be watching the consumer expectations for inflation. You can look at the University of Michigan numbers for the last 40 years. You go back on the left-hand side, and you can see what they were during the great inflation when Paul Volcker had to come in. They have turned up a little bit on the far right there, but we're nowhere near where we were. So you can watch all these numbers. Particularly on Friday, we get the PCE inflation numbers, which the Fed follows, and we get those University of Michigan numbers. Follow the inflation expectations and look for rising wages.
Well, the narrative matters, and I think we should discuss that just briefly, Mike. When we have people come on programs like this and say transitory, 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 that needs to resonate with the general public. The narrative does matter.
Oh, it absolutely does. And people are going to be looking at their paychecks and saying, am I keeping up with inflation? And remember that people have a distorted view of inflation. They think it goes up a lot more than it does because they watch things like gasoline prices, which go up and down, and the Fed kind of ignores. The American public doesn't.
Some people might say the American public has a more accurate read on inflation than perhaps the Federal Reserve, but that's a very separate debate, Mike. Thank you. Michael McKee. On the Federal Reserve next week and some data too. Joining us now is BlackRock's Marilyn Watson and Christian Muller-Glissman of Goldman Sachs. Marilyn, just on the Fed, there's a feeling that next week is just setting the stage for June. See you in June. Do you agree?
I think to a large extent that's probably true. We have seen much more of an upbeat tone from Powell in recent weeks, but I think really June will be when we actually start to see anything in terms of signaling towards a potential taper and whether we are getting towards this substantial further progress in the economy, which is obviously what the FOMC has said that they're looking for. So I think, listening to your guests earlier as well, I think what's important to see is that we have seen this volatility in bond markets. We have seen nominal yields remain pretty subdued still, particularly in the Treasury market. And I think that is because the Fed have done a very, very good job of continuing to sort of toe the line of saying that they're going to continue to support economic growth. They have this dual mandate. But I think as we do look towards June, then I do think the market is really going to be very, very, very focused on the very impressive data that we're seeing in the economy so far, in the inflation measures ticking up. And so I do think that, we will see a little bit more of an upbeat message next week. But then I do think, as you say, it's going to be setting the stage really for June.
Kristin, you've made the point that you still think the yields here are still far too low relative to what you're expecting to happen in this economy.
Yeah, no, I think that's right. I agree definitely that the upcoming meeting, it's too early for taper talk, and I think they need to balance the risks and the uncertainty. But I think you're right that the steepness of the curve in particular, we think, has the potential to increase. I think the front-end pricing of the Fed and also the front-end inflation expectations, they've come a long way. But if you do look in particular, the longer-term real yield, the 5-year TIPS yield, to us, that's still too low. That's still like 30, 40 basis points below where you were before COVID. And to some extent, that's linked to the longer-term outlook of the economy and our star. And you could argue people were incredibly bearish at the time. But this cycle is starting with a very different tone with regards to fiscal, with regards to growth. And I think that means the curves could steepen quite a bit more.
Well, Kristin, wouldn't you say that pronounced real yield being lower than it was before, wouldn't you say that's a reflection of the shifting reaction function of the Fed, that they're determined to keep real yields maybe lower?
No, I think there's definitely that contributes. There's a lot more leverage, and there's a perception that economies might not be dealing well with higher real rates, and as a result of that, central banks are to some extent accepting lower real rates and possibly even keen to keep real rates low. But I would still argue that the kind of from a level point of view, if you just think about where we are right now on the 5-year, which is kind of 30, 40 bips, I think it just seems that over the course of a few quarters, the latest, where you see that growth continues to be decent, above trend, and you have healing in the economy, that the market can take up that longer term view on rates because you're coming from such a low level. I agree that at the margin, there's maybe a tolerance for lower real rates from the Fed with AIT and with the world we live in. But I think the levels still seem a bit too low to us.
Do you agree with that, Marilyn?
I do. So I do think that, I do think that yield's going to continue to rise. I certainly think if you look at the 10-year, for example, we definitely think that's going to increase. We are short duration still in the US and treasuries. I do think there's also scope for the yield curve certainly to steepen further. It has been kept a bit muted by the sheer demand of investors looking for carry, including investors from abroad. And so I do agree. I think that we will, see a steepening of the curve. I do think we'll see yields higher as we start to normalize and come out of this incredibly complex, unusual situation where we have huge amounts of liquidity. We have very strong economic data coming through. We have inflation ticking up, and yet we have yields and real rates at these incredibly low levels. So I do think we will start to see them creep up.
I guess I just don't know what normalizing means anymore. Maybe it's not what it meant before. Kristin, just a final word on this before we move on, and we'll return to this conversation. You think because where real yields are right now, there is greater scope for higher macro volatility. What do you mean by that, Kristin?
Yeah, I mean, it's a bit like what was mentioned earlier on the program. These bond sell-offs, they seem to come in stages. And at the margin, we've had a decent consolidation now where I think the market has gone very aggressive on the reflation trade across assets since the vaccines have been developed. And I think we've gone through a bit of a consolidation now where from a level point of view, you kind of have maybe a bit worse asymmetry again. And it requires just a kind of continuation of macro surprises in some shape or form that you do get momentum again. And I think this whole idea that rates volatility can settle again already now seems a bit too early to us. And I would definitely agree on this whole idea that the bond sell-off will be very different from here. Most of the rates volatility you tend to get from policy. If you look in the last few years, like often the big bursts in terms of like yields came related to policy. So if you have something which is more driven by the back end by real yields, it might not be as volatile as a taper tantrum or so. But I think the asymmetry is really towards still quite elevated rates volatility and higher rates, I would argue.
Christian, let's pick up on this point in just a moment. Marilyn's going to stick with us as well. We'll continue this conversation. Coming up on the program, we'll get you some of the morning calls, some of the analyst action for you. And later, the stocks most likely to feel the pain of the Biden tax proposal. That conversation still ahead with BlackRock's Marilyn Watson and Christian Müller-Glissman of Goldman Sachs from New York. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Equities slightly firmer going into the open on the S&P 500, up 1/10%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Citi raising its price target on Charles Schwab to 93 from 88. The analyst seeing a buying opportunity amid tax worries. Piper Sandler downgrading Kraft Heinz to neutral. The analyst saying inflation is hitting many of the company's commodity inputs and saying the risk-reward is unattractive. And finally, Wedbush upgrading IMX to outperform, raising its price target to 26. The analyst saying the company should see strong demand as the economy reopens. We're firmer there by a little more than 4%. The opening bell's up next. Equity futures doing okay. This is Bloomberg.